Good morning, all. This hearing is now called to order. We continue with the cross-examination of Mr. Jennings. Mr. Jennings, you're still affirmed. Okay. Mr. Worm.
Good morning, Chair. Good morning, all. Yes, Mr. Jennings. Yesterday, when we started, we were going through, and we had up the on your test year, 31st of December 2020 income statement on page 719.
Yes, I am right there with you.
Yeah, I just want to finish that quickly, just to go through and make sure we covered all of the issues, and we were at amortization of leases. And I just wanted to understand what that was, because that seems to be something that came up from 2019. That was a change in accounting, or what was that associated with?
So the amortization of the amortization of the lease for the land associated with Lamberts.
Land
Associated with Lamberts, so that's
Lamberts.
Lamberts, so
okay.
that's not used and useful on the current.
Okay, cool. Okay, and the amortization is just that is not that's a lease amount that goes in there.
Yeah, that's the amortization of the right of use asset, and that is excluded from the revenue requirement.
Mr. Worm?
Yes, sir.
Amortization is akin to depreciation. It's similar to depreciation.
Okay.
So we would depreciate fixed assets, but you would amortize
leases?
A lease. So it is akin to how we treat.
So it's just really, it's like a rental payment. In other words, a lease would be like a rental payment, and you just, sorry, just
yes,
don't think we amortize leases, rentals, so I just was trying to understand it, but thanks for the clarification.
If the witness could
Yeah,
identify the type of lease and therefore how the treatment of the lease payment would be dealt with.
Sure.
Okay, thanks.
It is, as the chair said, it is a lease for land associated with the Lamberts wind farm, and as a result, that has been excluded from the application.
So is it a capital lease or?
It is. Sorry, it is a capital lease.
Okay.
Thank
So
you.
now I understand why you amortize a capital lease as opposed to just an expense, which would be a rental. Yeah, thanks. You also had generation costs there of 44 million. Is it $620,000?
Yes.
And you then, and that includes all of your generation costs other than fuel.
That is correct, yes.
Okay. And what is the adjustment that you have made of the 4.16 million? I think it may have been mentioned, but just to clarify.
So if we look to D7 will show the net amount, the breakdown of that net amount, sorry. So on D7, D7-6, I'll try and make this a little bit larger. So you'll see here that the adjustment is to remove $4.6 million out of depreciation expense in a test year, and that's made up of a couple removals and the additions for some known and measurable amounts. So the first one is the removal of the cost of rental generation that occurred in the test year. So that relates to the rental generation of 9.6 million. So that's been removed. That's not expected to recur. And that's not asked as part of the revenue requirement. The GTO1 expenses have been excluded, consistent with the last application. the other Greco expenses, so Greco is a company from which we rented the generation, so the other expenses associated with that rental generation were also excluded. And then the two that were added were during 2015 there was a prolonged outage of, well, that should read LSD 15, not LSB, sorry. So there was a prolonged outage for one of the base load units for LSD 15, and during that period the lubricant costs would not have been incurred, and the estimated amount for that lubricant cost was about 1.7 million. So to show a true reflection of what the expenses would normally be, 1.7 million for that lubricant cost was included. And an estimate for the Clean Energy Bridge annual operating and maintenance expenses of about 4.8 million was included. And of course, the reason for that is because the Clean Energy Bridge is expected to be, well, was expected to be in service at time and is in service now. So for the purposes of determining revenue requirement, these amounts were included. So the net of the 5 items there is a reduction of generation costs of 4.6 million.
So basically, the cost of the generation rental, as Mr. Blackman mentioned the other day, that was not covered, or you're not intended to cover that at all through rates.
That's correct.
Right, and it was absorbed by the company.
Yes.
Because I know that was a commitment that you made at the beginning, so I'm glad to see that that has been achieved. Just to go, next one is distribution. That obviously is maintenance costs associated with distribution, all the lines, etc. So just confirm what that is, and then we can move on to quickly to the next ones.
Yeah, so the distribution cost is the cost associated with running the distribution, all the distribution expenses. Yeah.
And as you mentioned yesterday, if you're replacing a pole or a major line section, that doesn't go in here, that goes into capital. I think you mentioned that yesterday, that you're capitalizing some of, if it's a replacement cost of a section, that you include that in capital, so that is not here as an expense.
That is correct. We would retire the section that is removed, and we would capitalize the section that is put in.
And that goes into rate base.
That goes into rate base, yes.
Right. Okay, and then on the finance, you've made an adjustment of $358,000.
Yeah, that is, again, we can go to D7. So the costs that relate to the acquisition of debt, or the taking on of debt, and that is charged to finance, so that is removed to be able to allow for the calculation, the true calculation of the weighted average cost of debt. So for the purposes of rate making, it is moved from there and put down to the finance cost, I believe. It's excluded from the revenue requirement.
Okay,
There'll be legal fees and that type of stuff associated with the acquisition of debt.
Okay. And then the taxes on other than income?
Yep, so we've included an adjustment there of a known and measurable. We requested an adjustment there for known and measurable. Sorry, I'm trying to get back to D1. Right. Yeah, so we've included an adjustment there for the land tax estimate associated with the Clean Energy Bridge.
And then your corporation tax expenses, you've removed that cost?
So in 2019 there was a corporation tax amount that was not booked and that was then booked in 2020 as a correction. So that was removed from test year because that's not something that's expected to recur. And the other adjustments that we've put there represent essentially the tax impact for the
deferred taxes.
The deferred taxes and the deferred credits for the implications associated with the known and measurable changes for the Clean Energy Bridge and the like.
Okay, thanks very much, because I think sometimes we take some of these things for granted and just as a number, and thanks for the explanations. I just want to go on to the rate of return. In this, I know you did not you did not do the capital cost study to determine what the rate of return should be, but I think you should be pretty knowledgeable, and any proposal that would be made by a consultant, I would imagine that you would have challenged. In its study, the expert had indicated a return of equity at 12.5%. Do you think in this environment where a utility that has a reasonably risk-free, and it's not totally risk-free, so I wouldn't want to suggest that it is, but a reasonably risk-free environment where you are granted a rate based on what are prudent investments, to get a rate of return of 12.5% in an environment where many other businesses...
Mr. Worm, I thought we had signaled that there would be some person presenting an affidavit on the rate of return and that you defer such questions.
Sir, I just want an opinion from the witness, if I may. That's all I am, because he would have not necessarily approved it, but he would have discussed it, and I just wanted his view on whether and why he thinks is reasonable, because he is in a Barbados environment, if I may. Thank you, sir. So I just want to find out, because in Barbados, I would argue, this is a discussion that many people are having. I'm not looking at the technical aspect of how it is, the 65, 35, etc., but just the equity.
Mr. Worm, could you just ask the question then? Ask the question.
Yeah. Is it reasonable, based on what I've just said, that 12.5%, where many other businesses, many other returns in an environment like we are right now, is that reasonable for a utility in a relatively risk-free environment to be earning at this point in time?
So I don't think that the utility is operating in a relatively risk-free situation. I disagree with that premise. But to the chair's point, I'm not qualified to be able to speak to cost of capital, and I do think that the expert coming after is the best person to speak to it. I did look at the report, obviously. I did read the report, and I'm comfortable with the conclusions that were reached in the report. And the other thing that comes to mind is, when you look at the rate of return as included in the feed-in tariff, as an example, it's not that dissimilar to the ask that is here. Those are my thoughts on it. But to the point that the chair made, it's not my area of expertise. It is a very specialized area, and the expert is the better person to give that information than me.
Okay. Well, I would just want an opinion, so. Okay, I just move on to the application itself. The reason that was Mr. Blackman gave earlier for the application was that, and I think had been mentioned before, was that the company was under earning, and you had attempted to go for rates back in I can't remember the date, 2019, or some years before, definitely at least a year before. When I look back at the rates of return that you are getting on the basis that you have indicated of the previous approved rate of return of 10%, Could you say that you are really under-earning that significantly, that you needed rates at that point in time? And this is forgetting 2020, because this would all of that discussion would have been prior to 2020. What would have triggered you to go and then develop the rate case based on those returns prior to 2020?
So if you exclude the impact of the tax in 2018, the rate of return is near to 8%. In 2019, you have a situation where you're under the 10 for sure, and you are looking at, by the end of 2019, we enter constructing a clean energy bridge, which is a significant amount of investment, and that, you're not able to earn your return in 2019, even without the clean energy bridge, and you then add the impact of clean energy bridge, that pushes you even further. And then, of course, you just mentioned 2020, but even without the dip in 2020, the inflationary pressures that you're facing, the growth in expenses, you're at that stage.
So if 8% is not adequate on a 10%, I mean, I accept it is lower than the 10%, but it doesn't seem to me to be excessively lower to make a statement that you were really under-earning significantly. Because as we look forward, you're also saying that even if you were to get the rates that you have applied for, when you go forward, even in the first year after, you're going to be under-earning again.
That's correct,
So,
especially given where we are now.
So my question, if 8% on 10% is too low, are you thinking, what does that mean for you then? Does it mean that you, having gotten this rate, you're expecting to come back to have another increase? Would that be the approach that you would take, or how would you deal with that for the future?
So there are a couple of things relative to that question. So the first thing is that the 8% that we would have looked at in 2018 was in the face of increasing and inclining in cost generally, and so you're faced with some forward-looking cost increase. And you're right, at this point we are in a similar type position. It's something that we're going to have to continue to look at and assess and try and figure out what's the right construct to try and be able to earn the return. But you are right. This application was based on a test year of 2020. 2021 has passed. We know that we were well under at rates of under 5%, around 4%. So that's a significant amount of a challenge. We're near the end of 2022, and for all intents and purposes, it does look to me like we're going to head around that same 4%. We did get an interim relief decision, which gives us some relief for the remainder of this year. But even with this, even if we were successful with this application, which I'm hopeful we will, because I think we've made a pretty strong case for it. If we're successful with this, we're still going to have challenges with how we're able to earn our returns. Now, there's some other developments that are happening in the market, and some other changes that perhaps may be occurring, and those would have to be assessed as they play out.
Yeah, but as the chairman mentioned yesterday as well, that already it looks like some of your forecasted numbers are incorrect, in the sense that he said, or for 2021 anyway, that what you had in your application, your forecasted number was not achieved, or it was, I think I heard mention about $198 million in one expense, and it actually ended up 163. And I also understood that your sales numbers were about a little over 1% higher than what had been projected. And I think in an interrogatory that you responded to also suggested that when you look at 2022, when you look on a monthly basis, your sales looks a lot higher. Like my calculation was about $4 million higher per month on average for the first 6 months. Sorry, kilowatt hours, not dollars, sorry. Sorry, kilowatt hours per month. more than what had been projected. So it looks to me that your maybe your forecast, and I would like to suggest that before the end of this hearing, that you have a look at that forecast again and then see what, and I don't know if through you, Chair, if I need to make a suggestion for them to come back with a revised sales forecast and financial forecast based on where they are today. Would that be appropriate?
Mr. Worm, there's a memorandum on sales forecast, and we will have a discussion on that after this witness.
Okay. Thank you. But it's the financial forecast I'm really looking at, because sales is only a part of that. So I think, because as you mentioned yesterday, sir, if I may. Okay, so I would like to suggest that once that sales forecast issue is dealt with, that we have a look at the sales forecast to see really where it is likely to take you. Because we know 2019 or 2020, when you made this application, there was a lot of uncertainty of where things are going. So I think it would be appropriate to have that.
Just just a comment around that forecast. I did hear the managing director have a conversation with the chair about it, and there are a couple of things that need to be thought about in the context of that forecast. That forecast would have been prepared on the basis of the Clean Energy Bridge coming into service in 2021, and that did not happen. So the potential saving that you may have referenced there, both in terms of the depreciation and the expense, is largely as a result of that. If you adjust it for the delays that you had in Clean Energy Bridge coming into service and look at it, what we look at in 2022, yeah.
And that's all I'm asking is, I want to look at it.
Yeah.
Yeah,
No,
I mean, that.
I understand what you're saying.
Yeah. Okay. I'm just trying to skip over, sir, to make sure that, just to your suggestion, we do not, because I don't know if it's appropriate for me to talk about the RPPA with Mr. Jennings, because I think as finance manager, he also will have some knowledge on that, which is the renewable purchase anyway, the RPPA, which is to sort of take the fuel clause out of the, put the fuel clause as only a fuel component, and all the renewable energy components will go into the RPPA. So I'll reserve that for the panel when it's discussing that. Just on, last night we received before that, sorry. It was mentioned previously that there was an increase in cost, in consultancy costs over time, from $50,000 to $500 and something thousand. Just to ask the question, where would these costs have been, consultancies? Would these have been technical consultancies? And I think you're going to provide that information, but I'm just trying to understand if a lot of them were associated with the technical changes that you are requiring to make as a result of this transition from your traditional approach in generation to the new one in renewable energy.
I'm not, so the comment, so I heard Intervena went asking the managing director about professional fees in the self-insurance fund.
Right.
And I think that was the basis of a response to the interrogatory that we had submitted, which is that those, and I think Commissioner Martinez also asked about it as well. So there are investment management fees that are incurred, and that's in the order of between 1% and 2% of the value of the fund, and of the value of the amounts invested in those funds that are invested for the fund. If I'm confusing everyone, let me step back for a moment. The self-insurance fund, the money in the self-insurance fund is invested in certain funds and equities and so on, and there are asset management fees that are charged by the fund managers and so on. That's in the order of like 1 to 2%. Prior to 2016, those fees were being net off against investment income, and the investment income was being remitted to us net of it. So it looks like a significant increase in fund fees, but it's just the fact that the asset management fee is now being recorded as a professional fee and not as a net against investment income.
So there weren't what I termed as consultancy fees, like for technical things. Those are strictly financial. And when you talk about fund, because we were talking yesterday about the self-insurance fund, which, as I understand, is a separate entity or a separate calculation than what you would have provided in your accounts for professional fees. Isn't that correct? Because those fees, I thought you were talking about those investments for self-insurance would have been all separate, or they're included in Light and Power's accounts?
Sorry, can you go over that just
no,
one more time?
When you're talking about fees for investments,
yeah.
and you mentioned about fund, unless I mistook what you said, does that can't be the self-insurance fund that you're talking about? Because isn't the self-insurance fund a totally separate, and that would not be shown anywhere in your...
it's not in BLPC's financials,
right.
It's in the self-insurance fund financials.
Right, okay.
And I think
so that was, sorry, all right, I got you. Okay, so it was related to that.
Yes.
Okay. And, okay, on the matter of rates, and I know you're not dealing with rate design, but it relates to the fuel clause adjustment. As you know, I'm very familiar with how that whole process works and the whole rate making process. But an issue came up, and it was discussed with the depreciation as well, about the installation of the PV system. And our members in BREA just wanted some clarification on some things that were said. When you install the PV system, as we understood it, that went and understood in this hearing as well, that cost went in, the asset cost went into rate base, correct?
That is correct, yes.
So the only cost that you are charging customers effectively, because up to that point you were working on the rates from 2010. So you did not get, as I understand it, additional revenue from the customers since that system was installed, or should I say increase in rates from customers to cover the cost of that system. Is that correct?
That's correct, but there's been no adjustment in tariffs since 2010.
So what you're saying then is that that cost was totally borne by the company to be able to improve service and cost to customers?
So the cost associated with that asset, the depreciation cost and the operating expense associated with that asset would have been included annually in our operating expenses and depreciation, and form part of the return on rate base that we would have submitted and recorded for each of those years. So no additional tariff was allowed for it, and there's no additional recovery for that sort of farm in the north. Right.
Except now this rate case comes, you've included that as an asset, so that would be included in any adjustment that is made.
That's correct.
So their question really was, does anything go into the fuel clause adjustment as a result of that? Because, you know, a lot of people confuse the feed-in tariff with how you're dealing with that situation. What is the difference between how you deal with it and how it's dealt with for other ownership in renewable energy? So just to clarify that for them. I've clarified it, but I want you to.
Thank you for the question. So Barbados Light and Power does not benefit for the feed-in tariff from that solar farm. Other renewable suppliers are connected and have a feed-in tariff agreement, and they receive a credit in accordance with the decision of the FTC and the feed-in tariff program that exists.
So there's nothing other than the asset that you're earning from that plant. In other words, you're earning that asset through rates, and there's nothing that goes through the fuel clause.
That's correct.
What about the battery energy storage device that you've installed at the same location in Trent?
So for the energy storage device, there is a reduction in, there's an additional bit of revenue that is earned as a result of fuel savings associated with that. But that, I think that was at the end of 2020, I believe, is when that is 18. It was
2018, I think, is when the
three-year period is what it was for. At any rate, in this application, we've requested that it be viewed as part of rate base and be regularized in the tariff structure.
So up to now, how have you been recovering that cost?
So on an annual basis, I think it is in February, the aggregate amount of fuel savings attributed to that battery storage device, 95% of it would have been transferred to revenue for the company, and 5% would have been left for the customer for it. And I believe the adjustment that we made in the application was about $200,000 of revenue that would have occurred in 2020 associated with that.
Okay, and the revenue came from the fuel clause adjustment?
Yeah, it was for fuel, yeah.
So, as I understand it, that did not go into rate base before.
No, that's correct.
Whereas the PV system did. Yeah. Nothing was passed through the fuel clause with the PV system, but for the energy storage device, it was.
Well, the way it was treated in the annual filings, it would have been included in rate base, but there was no tariff adjustment for it. So the revenue would not have been excluded and calculated in return. So the overall revenue, which would be the tariff revenue plus whatever fuel savings you got on account of it, would have formed the return, and that divided by the rate base, which would have included the battery. But for the purposes of this application, we've asked that to be included in rate base and be covered by the tariff rather than having that fuel arbitrage.
Right. So leading up to now, the only things that went through the fuel clause adjustment were fuel costs, the sales for, and this is a question, is that correct? That the only thing that went through fuel clause adjustment was fuel costs that you used in fuel you used in the production of electricity, the energy storage device, that calculation you talked about, and the payments that you've made to customers in the renewable energy feed-in tariffs. Is that correct? Those are the only things that went through their fuel clause adjustment?
To the best of my knowledge, the cost of fuel, the cost associated with fuel, the cost associated with the battery, and then the purchase power.
Okay.
Yeah.
And to the point that you made, you have on the energy storage device, just a point there, that you have depreciated that over the years.
We have.
And the question, but you have also gained revenue through the fuel clause adjustment. What portion of that asset was actually recovered already through the fuel clause adjustment? Or, as you said, you have backed that out, I guess, as revenue, and I just trying to understand how you would have gotten revenue, which would have paid for part of it. Has what you have reduced that value down to, is that in the same amount of what you have been able to collect through the fuel clause adjustment?
I don't have that information in front of me, but we certainly can pull that up.
Yeah, because I'm just trying to find out, because now you have a depreciated amount you're putting in, but you have already gotten some of it back. I don't know if it's more, you may not have gotten what you expected, but just to confirm whether you're just making sure you haven't are not going to be earning on something that you've already been collected from the customers, and if a further adjustment needs to be made to accommodate for that. It could be one way or the other, so I'm not, I'm not saying that you've done anything that you shouldn't have. Who monitors your fuel clause adjustment to make sure that what I am saying about what goes in and is there, whose responsibility is it to make sure that what you're doing follows the rules that have been set down by the Fair Trading Commission?
So the company deals with the fuel clause and sets the fuel clause in accordance with what the regulator has set out, and the company also reports to the regulator on a monthly basis and quarterly basis and an annual basis as well.
And so the regulator has the opportunity to review that monthly. Is that correct?
I believe so, yes.
Okay. And maybe the question to them is because I know many years ago there was an audit on that process which resulted in some changes and improvements, and I'm sure that they will identify when that needs to be done again. On the last matter now. Last night we received a document which identified or in response to the queries about the self-insurance fund and the value of what it was. And what struck me was that that study was done by the same company that was the beneficiary of any adjustment. And I'm not aspiring any motives to it, because I think these are companies that have high integrity, and I actually know one of the persons that did the report, and he's very much above board. But my question to you really is, from an optics point of view, is that reasonable that looking that here you have a company that is going to be receiving the beneficiary of any recommendation or benefits of any recommendation, or maybe costs, are the ones to have actually done this study to determine what that should be? From an optics point of view.
Well, I think the more important piece is whether the people who've done the study are adequately qualified to do it, and whether the study itself is robust and whether the study itself is reasonable.
Yeah, and as I said, I'm not questioning that. I'm just saying from an optics point of view, I think it really struck me. I know we talked about AmeriCaribbean doing this study. I thought who initiated this study rather than being the people who did the study. And as I said, I'm not suggesting any ill motive or anything like that, because I would not expect that any
Mr. Worm?
company of integrity. Sir, yes, I understand. I just want to make sure that we recognize that. What I also noticed from that report was that, or it seemed to me that they have planned for a 1 in 100 year incident, which, you know, I mean, people will plan it based on 1 in 50, and they gave a lot of.
Mr. Worm, the question.
Yeah. Okay, so my question, having seen that, is what is and I asked you yesterday, and without the benefit of that report, and that report did recommend, I think, like $46 million. To have. But you also have, is it correct that you also cover beyond the T&D which that identified, also cover the deductibles on other insurance items?
To the best of my knowledge, it can be used for that, but currently it isn't used for that.
I thought I heard that it did to bring down the price of the insurance.
The deductible is
right.
set to bring down the price of the insurance, but We haven't used it. We haven't made any claim from the self-insurance fund for deductible
Right,
with
okay,
claims
no,
that we've had.
okay, I understand. But in the case of a hurricane,
Right.
you're not going to only have damage to T&D, and that focused on T&D damage. You may also have to pay that first part of any generation expense as well. My question is, based on that, if you exceeded, or should I say, if you took out of the fund and you had to rebuild that fund and then you had another incident, how would you deal with that loss? Because that loss, for example, if a self-insurance fund is not adequate to cover those losses on the second incident, how would you deal with that? Where would the money come from for you to be able to pay the cost of rebuilding your system if the self-insurance fund is exceeded?
I think the third-party insurance is quite adequate for generation assets. I think the study looks at what happens with the T&D assets, and I think you're right. I think it does speak to the 1 in 100 incident, but I think you're asking me to opine again on the study. Like the study sets out what the view is.
My question, though, is if for some reason, I mean, we just saw Ian hit the west coast of Tampa, and I can assure you that nobody anticipated that level of destruction.
Agreed.
The question is, if we had a level of destruction, and it's not necessarily the first year, it may be, $10 million the first year, the second incident maybe another 20 million, and before you know it, when the third incident comes, we may not have enough to cover both the excess of generation as well as that.
Yeah.
My question to you really is, where would that money come from to cover that? Would that then be something that customers will be required to pay for, or would that come out of the company's effectively return, basically? How is that? How do you see that working?
It would depend on what the situation is that leads to that, and then if the other piece, again, you take me back to what's actually in the study, and the challenge that I have is, if you have a hurricane today and it knocks out a certain amount, you're asking what's the likelihood of having one just after it, or you're asking, what's the damage likely to be if you have one just after it, or what's the recovery going to be like, or what the situation
I'm not
will be.
asking what they'll be like. I'm just saying, if for some reason all of that happened,
Yeah.
and you needed funds to cover your
Right.
costs,
Yeah.
is the shareholder going to take that money and give you to do it at no expense to customers, or would that you be coming and asking customers to pay for that?
Right. So I expect, much like if you had repeated fires at a generation and you exhausted insurance, that you would have a situation where you would have to come back to the drawing board to figure out how to do it.
Okay, because I see it having gone where you've taken out $100 million.
Yeah.
And it's gone to the shareholders. Something has, if it goes over the 50 that they say that they're protecting for, they have to have some responsibility in that. But as you said, that may be above all of our pay grade right now. But other than the fact that at the end of the day, we have to make sure that customers are adequately protected against actions that any shareholder or any other person may make. Mr. Chairman, that would be my last question, and thank you very much for the opportunity to discuss with Mr. Jennings.
Thank you, Mr. Worm. Intervener team, Watson and Simpson.
Thank you, Chair. Good morning, everyone. Mr. Jennings, I think it might be worthwhile for me to just put a couple questions following on from where Intervenor Worm left off. Because it was an area that I was trying to wrap my mind around in terms of the risks. And when I look at the information surrounding the self-insurance fund and so on, I got the impression that the expected risk to the company and its assets was being based on, to some extent, on the lack of occurrence of any natural disasters of any significance in Barbados in recent history. In your opinion, is the company satisfied that that is the best way to go? And following on from Mr. Worm's question, these natural disasters, and in our own, was it last year, freak storms, and then we had Elsa, is the risk coverage satisfactory for the company in terms of the protection of the assets?
So I believe, sorry, I believe the study supports that view, yes. And the follow-up study that was done afterward too.
In terms of risk, what would you highlight as the key financial risks that face the company at this time?
So the financial risk that the company faces, I've outlined in the memo on the rate of return. So if you look at paragraph 14 in that, you'll see we have high capital expenditures and dependence on future revenues. We have an island grid system and infrastructure, including generation mix. We do have climate and weather risks such as tropical storms. And we have increased penetration of independent power producers and new market structure, dependence and access to foreign currency, as they outlined as the key risks in that memorandum.
Right, so all of these financial risks listed in the memorandum require BLPC to have funding or to be able to readily access funding to address these risks, because climate and weather, increased penetration from other power producers and so on, all of these require a major part of financial response from BLPC. Would you agree?
I would, yes.
So I will ask the question again based on that then. Are you satisfied that all of these financial risks and the company's access to cash are satisfactory in terms of the risk assessment that has been done?
So the response to risk would be more than just having access to finance. There will be risk mitigation strategies that a company will put into place, and it needs to be balanced. So what we look to do, so as an example, the dependence on foreign exchange or the dependence on fossil fuel, we don't have fossil fuels ourselves, or the dependence on foreign exchange to be able to buy what we have. You have to balance the risk associated with mitigated efforts, and I don't think that it is as simple as to have unlimited access to finance, but at the same time we need to balance it with the understanding the risk, measuring the risk, and making sure we have the ability to respond. And I believe that that's what the study sought to do. The study looked to see what's the level of risk that you're looking at, what's the level of potential occurrence, what's the level of expected exposure with that risk, and what's the right amount for that risk. Now, will it play out exactly as the study is? But perhaps not, and we're all hopeful that the performance exceeds what's in the study. But it's a bit of looking into the future, and you kind of need to set a band within which you're prepared to operate.
Okay, so I want to turn to the rate of return for a moment. And in your earlier testimony, you indicated, and is in the response to interrogatories and so on, what the actual rates of return were for the last 10 years. And I'm just trying to find the document, sorry. And clear as to the components of the calculation and so on. And you would have had rates of return that range from 8% in 2010 and have now fallen to 3.01 based on 2021 calculations. What is not clear to me from the submissions is, and I'm going to ask you, can you indicate what the target metrics are to achieve the constant 10% return or the current return that you're asking for? So in other words, we know that the calculation is for the rate of return is based on the size of the rate, based on the current operating income. So have you determined what those target figures must be annually in order to maintain your requested rate of return?
No, so what I think the flip is kind of what you look at. We look at the test year and we look to see what the revenue requirement to cover reasonable expenses would be. And then I think the idea of doing the 5-year forecast is to look out with the sales projection, and the expansion study, I think, looks at where the capacity is going to come from and then looks to see what the expense profile is relative to those expected sales, and then look to see what the rate of return is expected to be over that period. So I don't know that you sit down to say, well, if we don't hit, 950 gigawatt hours of sales in the next 3 years, that this is what we're going to do. We're going to try and cut depreciation. I don't think it quite works that way. Does that help with what you're trying to get to?
I think so. Thank you. Would you agree that the rate base and naturally the operating income will vary and fluctuate from year to year, regardless of the 5-year forecast?
It is at risk of fluctuating. I mean, if you look at the history, the rate base hasn't fluctuated that much over the period. When we do have a couple of situations, like when we've built the solar farm, or where we put in a major investment like AMI, or we build this clean energy bridge, that you have the growth in the rate base. But you don't expect it to be very volatile, no.
But in 2014, what was the rate base of the company for the rate of return calculation?
I would need to check to see. Just give me a minute. In 2014, about 480 million Barbados dollars.
And the rate of return calculated for that year was?
9.24%.
Now, if we move to 2021, the rate base grew to?
About 800 and... well, the rate base in this application is 825. We could use that if you're okay with it, which is a significant increase to the 490, yeah.
Correct, and we're talking about a span of 7 years.
Yeah.
So what I'm getting at is, in 7 years, you've had a change in your rate base of 400 odd million. You've had declining operating incomes, and in 2014, you were pretty close to the approved rate of return that the Commission granted. So what I'm trying to get to is, these variables are going to change on an annual basis, and you've calculated a projected requested rate of return for the purpose of this review. And we acknowledge that these are, well, I think everybody tries not to use the word abnormal times, but this is the essence of the situation.
Right.
So how can the Commission be satisfied that the requested rate of return is going to be satisfactory based on the 5-year forecast, and that the Light and Power will not find itself in a situation where after 2 years they deem it is unsatisfactory and have to return for another rate review?
Yeah. So the forecast shows that the forecast when it was done, because there's quite a bit of time that would have happened between when the forecast would have been prepared, and some time has elapsed. You've had a year or two. It showed that with the rates that have been applied for the while it does not cause you to hit the target return, but it improves the ability to earn the return. So we know that on a 2020 test year, that at least these rates get you closer. Now, the forecast is just that, it is a forecast, and there's quite a bit that is changing in the industry now. Now, how that change happens and what happens beyond now, I think we've had a lot of discussion in this hearing so far about that not being part of this application. So I'm cautious around how I approach it. But to answer your question, with the change in times and with the change of what's happening, it's going to have to be evaluated as it unfolds. And I'm not able to sit down here and testify to say that you're not going to end up right back here. I'm going to say that you're going to try and manage as best as you could, as we have always done. Seeking a rate increase is always the last thing that we are looking to do. But we need to make sure that the company is able to recover its costs once, of course, they're prudently incurred, and the examinations like this help demonstrate that. And when that does happen, the determination gets made then.
I want to turn briefly to the discussion on capital structure, because on the examination by counsel for the applicant, you outlined that the dividend policy / dividend payouts were an essential component of the company being able to manage its capital structure. Am I correct?
You are, yes.
Right. And I believe reference was made to the ratio, equity and debt, which was in the vicinity of 80-20, and the efforts that you made in terms of achieving 65-35. Am I correct?
Yes.
Now, is the company asserting that the level of dividend payouts since Emera became the 100% owner were strictly to achieve that change in the capital structure of the company?
Well, I don't think it really matters who the owner is. I think a reasonable investor would expect a return on their equity, and the way that they get that return on equity is largely through dividends. You have $550 million in equity, which you have in a company. If you assess the cost of equity to be 12.5%, then a reasonable return is about $70 million. And the way that you give that to the shareholder, that return, you don't just earn it. If you give it and you give it to the shareholder, would be you'd give them a dividend of $70 million. But that being said, you also need to look at other factors like the circumstances that you are facing, and one of the things that we've been trying to manage and get to is that debt to equity ratio. So the reason I explained about a reasonable rate of return is I think reasonable rate of return is ordinary. It's contemplated in the legislation. It is what is required to be able to attract investment and to be able to achieve reasonable rates. And dividend is one of the ways that you're able to reduce the equity out of the business and get closer to that 65-35 ratio that we think is a reasonable position that is in the interest of customers. Does that help with your question?
Yes, it helps with the question, and the first part of your response was my understanding as well. And so I'm really zeroing in on the statement that the dividend payouts are being used to adjust the capital structure of the entity. Your response on rate of return and what the shareholders are justified in getting and so on is fine. My concern was around understanding better the statement that the dividend payouts were, because the impression was given, I think, that the dividend payouts were central to the company's efforts to achieve that 65-35.
Yeah, they do. They help. If you earn and you continue to earn and you build up retained earnings, then you end up with a higher percentage of equity in the business, and the only real way to relieve that is to pay dividends. So it is central to it. All I'm saying is that there are several factors. One is the investor has a right to earn a reasonable return on the investment. That's normal. But then in addition to that, you're trying to target a capital structure that is in the interest of customers. And the dividends help you achieve that.
But what is the impact of achieving those things on the company itself? Because as you outlined yesterday, the components of equity are the share capital and the retained earnings. And of course, dividends being paid out of retained earnings also affects what the company retains for its own reinvestment and its own growth. So how does BLPC balance that act to achieve the 65-35 but not put itself in jeopardy in terms of its ability to reinvest in the operations of the company?
So the idea would be that as you pay the dividend and you're looking to make the investment, you then look to raise debt to be able to do it. The challenge comes in when you don't have a reasonable rate of return to be able to raise the debt at reasonable rates. That's where it becomes an issue. So if you're trying to manage debt and equity, if you have to get rid of equity and the asset base remains the same, then the only way to fund that asset base is through debt. So the idea is to try and raise the debt at reasonable rates, which is why you need a reasonable rate of return. Does that help?
Does the company have one category of shares in issue?
To the best of my knowledge, yes.
And that category is?
Ordinary common shares.
Okay. There, Mr. Jennings, I want to turn for a moment to, there is a document that you submitted as, I think it was a response to an interrogatory, and I just want to make sure that I understand.
Okay.
I think it was a document entitled the Balance Scorecard or something like that.
Yes.
I'm trying to find the right name of the document for the benefit of the panel, sorry. Today is not my luck in terms of pulling up the right document.
I actually can't find it myself either.
But it is a document entitled Balance Scorecard and Performance.
Chair, just says it's in the August 25th responses to the Ministry of Energy.
Yes. Thank you, Council. Appreciate it.
Set 4.
Right, so the title of the document is Corporate Balance Scorecard Incentive Plan, and there's information for financial periods 2019 through 2022. Can you just explain the purpose of the document, what the document is meant to achieve for the Light and Power Water, what metric it is actually measuring and how it is used?
So the scorecard is used as an incentive tool to incentivize staff. A small portion of staff's remuneration is what we refer to as at-risk compensation, which is essentially, if the company does well, the staff benefits from it. If the company doesn't do well, then the staff doesn't benefit from it. It's typical for most organizations, to the best of my knowledge. Those targets are broken down into a couple different areas. They focus on customer, focus on safety, focus on sustainability, financial focus as well. And the targets are set to measure the progress and the success of the company and to allow the employees to participate in and to be motivated by achieving the success associated with those particular areas.
So where we have the objective of strong financial results under financial performance and using the income to measure, where we see the target says $48.70. Can you explain what that means?
That would be, I don't have it in front of me, but I think I could recall. That would be a target based on net income for that year of $48.7 million.
And then it goes across and it mentions 5310 as a stretch.
So how it works is that you have a threshold achievement, a target achievement, and then a stretch achievement. So depending on whether for each of the metrics you achieve the stretch, the target, or the threshold, there's a point weighting system that affects what the amount of the incentive compensation would be.
So when the result in that line says between target and stretch, can you confirm what that means?
So what that means is that you would have, thank you. So what that means is that you would have achieved a result that is between target and stretch.
So the company's net income performance was between the target figure and the stretch.
For compensation purposes, for the incentive compensation purposes for the staff for that year, that's correct, yes.
So how does this performance link to the actual financial performance of the company?
So this,
in dollar figures,
I was looking to see here. So what this does is this looks at what you based on the budget that you have and based on the situation that you face, what you think a reasonable target would be to be able to incentivize staff to push toward achieving that. And again, it's for customer, it's for focus on customer, focus on people, focus on safety, sustainability, and financial performance. So it's spread across the 5 different areas, and there are targets there that are meant to be achievable and intend to motivate staff to be able to achieve the objectives in those 5 areas.
Okay, so those figures
Could you scroll it?
I couldn't find it.
So
I'm not sure who's controlling it.
Scroll it slightly to the other direction. Yeah. Okay. Yeah, thank you.
So, Mr. Jennings, those initial figures I quoted were from the 2019 scorecard. In terms of, so how did those targets change between 2019 and 2022 in terms of the performance, the net income performance in relation to incentives?
So if you could go to the 2021 or 2022, you'd see that the targets were set based on what would have been, if you had not seen the financial ones.
Financial net income, I think the threshold was 41.8, the target 52, and the stretch 61.
Right. So again, those have been set based on the circumstance at the time, the budget that would have been prepared, and what would have been assessed and deemed and approved by the board of directors as appropriate targets and stretch and threshold for motivating the staff.
Excuse me, Mr. Jennings.
Sure.
Do y'all are these listed in order of priority, or is an order of priority given to these goals?
There's a weighting. If you look in the column that says measure or weight.
No, I want to know if you have an order of priority.
No, to the best of my knowledge, there's no order of priority. No. I would suggest that the weighting would be a best measure of order of priority, would be my guess. Sorry.
Okay, so Mr. Jennings, I think we are clear there. So the targets are being set based on your budget and your expectations, but then when we look at the result, it indicates where we see between stretch and target or below threshold, that refers to the performance of
That's
the company
correct,
in
yes.
relation to those targets.
That's correct, yes.
Okay. And then based on that, some incentive is paid
Yeah,
to the staff, primarily based on the performance of the company, not so much as the performance of the staff itself. You link.
that's correct.
Okay.
The staff is incentivized to achieve the targets of the company. That's correct, yeah.
Now, the forecast, I want to go through with you a little bit to make sure that we are clear. And my initial question to you will be that in the context of this rate review, the financial performance of BLPC and its viability and sustainability are critical. Would you agree?
I do.
Okay. So, in a response to an interrogatory, and I'll start with that one, you responded, I think there were some full responses to some interrogatories submitted on July 29th, I believe it was. Accompanying your affidavit as customary, the reference was FTC-01/2021, BLMP RRA 2021-1004, and Exhibit RJF5, I believe. Responses to interrogatories from the FTC dated July 29th.
Just give me a second, I'll see if I can find it. July 29th?
Yes.
Okay, I think I have it.
Now, your response to question one there indicated, notwithstanding the current cash at bank at the end of June 2022, that you needed to satisfy certain obligatory payments, etc., from July to September, which exceeded 2 million, and that projection excluded 50 million of capital expenditure already deferred on account of cash flow and other challenges. Now, we've heard earlier testimony that the sales of light and power have been flat for the last, am I correct in saying the last 5 to 6 years was the testimony? Can you indicate in terms of the flat sales that the light and power has experienced, what has been happening on the other side in terms of the expenses that are incurred in support of earning those sales that have generally been flat?
So, generally, 5 to 6 years, hold on. You're talking end in 2020, or you're talking coming to now as well?
Coming to know as well, because some of the information in the interrogatory goes as far as June, July 2022.
Okay, so if you maybe start at, there was an interrogatory response that we did that might show that a little better. I think Mr. Blackman was using it as a response to one to Mr. Went, I believe. See if I can put my hand on it. Right. So this goes as far as 2020. So you could see, I don't know if you can see, I could try and make it a little bit larger. You can see that the sales in 2015 maybe 191, 2016 196, 2017 197, 195, 196, 186 in 2020. And I think your question is related to what's happening with the expenses in that period as well?
Right.
Yeah. So you would see, well, we could start with depreciation. You could see that the depreciation is going up. 37, 45, 46, 49, 46, 52. So you're seeing increased depreciation. There's a bit of expenditure on capital that has been happening there. And it's kind of hard to see it on this sheet without the fuel and the depreciation. I think there was another interrogatory that we submitted for, I think, to Mr. Wendt as well, actually, that looks at the expenses over the last couple of years as well. Just bear with me a second. This is FTC. This is rent. No, not this. Yeah, so this here shows, I believe it shows. So this was the response, September 9th response to Mr. Wendt on for the 31st of August. This shows that the other expenses in 2016 were at 81 million, 2020 94.8, and 2021 98.1 million. And you would note that in 2020 you've had the rental generation at 8.9 million, and 2021 7.7 million rental generation according to that jump. So the insurance is giving you a bit of a push up, and with the non-fuel other expenses, you see it kind of trying to hold, but you do have some inflationary pressures causing some additional expenses too. Of course, in 2022 now, with where depreciation has started, it has started to give a little bit more headwind.
Okay, so based on that profile, between 2016 and current,
Yep.
has the company experienced cash flow deficits or significant cash flow challenges in that period?
So we've not experienced cash flow deficits. We obviously tried to manage the business as best as we could to avoid cash flow deficits. We have had to defer some investment, and we have had to try to manage certain expenses. The managing director did testify to that quite a few projects that had to be delayed or deferred pending some relief, particularly in the last 24 months or so. So I wouldn't want to rehash his testimony, but you've already heard that. Yeah.
If I come to the document you submitted, the response to interrogatories in terms of obligations for July, August, and September, I just have a few questions for better understanding because,
Sure.
For example, the first line that was in the document, well, we saw that on average, the estimated obligations in terms of disbursements and payments were just over 70 million for July, 62 million for August, and almost 72 million for September. The first line that you had there were commitments to loan payments, and July was 1.75 million, August 3.1 million.
You're in the Word, or you're in the...
This is the response to the interrogatories submitted on July 29th. And
Okay.
I believe your response
Okay.
was an extract from another document, but it was placed in the response to the interrogatories.
Okay, so you're at question 2?
Yes, correct.
Okay.
Can you explain what appear to be significant variations in the loan payments in each month, from 1.7 million to 3.1 and then down to 642,000?
Oh, yeah, sure. We have a loan profile. We have a loan portfolio of, you know, $200 million, and they have different repayment dates. That would cause the different volatility. So some of them have principal payments due at different months during the year, and so that would have been the cause there. I couldn't remember exactly which ones were due in July and August, but there wouldn't be a consistent loan payment every month, no.
Okay, so that's why I wanted to make sure it was clear.
Yeah.
There are monthly payments, but they're not necessarily consistent for all of the facilities.
We don't actually. I think we had one loan, the RBC loan, that had a consistent monthly payment. I think that's now been extinguished. But the other loans have different quarterly repayment dates, and we have two loans that are non-amortizing loans, so they only receive bullet payments. And those get paid, I think, every 6 months, if memory serves me correctly.
Okay, noted, and thanks. The maintenance contracts, again, there's a variation there. And I know it's just a 3-month window, but I believe your explanations would explain.
Same sort of context. That is that those maintenance contracts have scheduled payment dates, and they're not every month. I think those, and the different people that we have maintenance contracts with, I believe they're every 6 months, but I don't think that they are the same payment every 6 months. Those maintenance contracts are for long-term service agreements, so to maintain the big plants.
And the payment for the clean energy bridge, would this have been a payment to bring it online or related to bringing it into use in the last few months?
Yeah, so that would have been one of the stage payments that would have been required based on one of the milestone criteria that they would have had for that contract, yes.
Now, you referenced earlier, I believe, in speaking about the financial performance, you did mention changes in insurance costs, I believe, and that was one of the queries that I wanted to put to you. And looking at the audited financial statement submitted with the application, we saw the decline in revenue, as you highlighted. We saw the declines in various costs, or costs being maintained constant. But there was a significant increase in the insurance. Can you just elaborate on what occurred between 2019 and 20 that led to that significant increase?
Yeah, just the insurance prices on the market have gone up. We pretty much have this. We would have had pretty much the same cover, I believe, to the best of my knowledge, in 2019 and 2020, which are seeing higher premiums out there with the brokers that we use. And if you look at 2021 is also a significant increase, which is, of course, why we've asked for the known and measurable change in the test year.
And you've seen similar increases in 2022 again, or has it?
2022, I need to check. I think we have seen some increase, but I don't think it is as dramatic as what would have occurred between 19 and 20 and 20 and 21. But I would need to look back at that to be certain. I don't think it was as dramatic as the level of increase between 19 and 20 and 20 and 21.
And the assets, these increased premiums are in relation to what assets?
They all that are available for commercial insurance. So general buildings, generation plant, substation buildings, and other insurance, other employees' liability insurance, public liability insurance, all of the insurance. I think a question was asked about that, and I think a document is being prepared.
Right,
to
so I was
circulate
just
for
going to
that.
say,
So
if
you'll get that.
hopefully
and-
that document
Yeah.
covers that increase and the premium notices of the increases
yeah.
and so on. All right, so Chair, if we can, I know the document, the coverage, cover notes, policies, etc., but we just want to also add to that list the premium notices of the increase in insurances and the extent to which the rates or the premiums were changing in that period. Okay, Mr. Jennings, I want to revisit our discussion yesterday on the steam unit that is being held for spare parts. And I know yesterday we explored the depreciation side of it. And I do note your response in terms of allow treatment under IAS 16. And I want us to go back to it from the point of view of asking you to confirm if it is your opinion and agreement that that spare part asset should be held as property, plant, and equipment and capitalized, as opposed to even the option of holding it as an inventory of spares, which is still on the balance sheet,
Yeah.
but would be a different accounting treatment.
Yeah, you're right, it could be. It could perhaps be viewed as a part of inventory, which would still feature on the balance sheet in rate base and material and space. So I don't think the geography really makes a difference to anything, but our accounting policy is to capitalize critical spares, and that's the manner in which it's been dealt with.
So it would be on the balance sheet still, and it would probably still feature in your rate base, but the difference would be, as inventory, it would not be depreciated, which is also a component of the rate base, not so?
No, it would still be, because the spares that are carried for plant also attract a provision for obsolescence that goes in every year that matches the life of the plant. So, and I think that's why the IFRIC allows for the capitalization, because I think the treatment is pretty much the same.
Okay, so that was going to be my question. In your opinion, then, either treatment would result in the same effect on the rate base?
Same result, same effect, but I think my personal view is obviously the treatment that we've done is the appropriate treatment for it.
Was there similar exploration of this matter with yourself and the team by the auditors in terms of the treatment under IAS 16, and that it would result in no significant differences financially or otherwise?
The auditors certainly have been through it, and they have not raised it as an issue. They were in agreement to the best of my knowledge, yes.
The clean energy bridge would have been carried for sure up to your 2020 audited financial statements as work in progress, am I correct?
You are correct, yes.
And the value in the application within the rate base for the clean energy bridge would have been what?
Just one moment, let me see if I can find it. I think it would be in Schedule C3. I need to find a quicker way to get to these things. $133,228,133.2 million.
And the CEB was brought into service when?
June 28, 2022.
Okay, and the value brought into service as the completed asset then was what?
We need to check. That was the response to interrogatory. It was closer to 140 odd million, I believe.
Okay. What other assets are included in, was the work in progress in 2020 strictly the CEB, or there were other work in progress assets?
No, if you look at Schedule C3, you'll see the list here of all of the other assets that would have been included as construction work in progress.
Okay, thanks for that. What is the intended depreciation policy for the Clean Energy Bridge?
So the asset management team have, well, you're going to have an opportunity to discuss that with them when they come up as well, but we're using 25 years, so the life is being spread over 25 years.
No, so we'll discuss life and so on, but in terms from a financial point of view, the policy for depreciation under IFRS will be, the rate used will be?
Oh, well, we're going to use, what's 25 years, 4%.
25 years, 4%,
yeah.
Okay. And that starts from the end of this current financial year?
We're going to do it from July 1, 2022.
Okay. My final question for now, because I believe my co-intervener has a few and then I may return. In relation to the SIF, because every time this comes up, another question is raised in my mind, but I just want to make sure that we remain on the same page. The dividend, the transfer to the beneficiary, and therefore then the payment of the dividend as we've been discussing. This payment also was effected based on the earlier discussion we had in terms of seeking to maintain the capital structure and the ratio that was desirous and being pursued by the company. Would that be your assessment of it?
I don't know. It would not have had an impact because it matched. So the return, it was in and out. The return of the income was on dividend, so it would not have really affected the debt equity ratio. If it was returned and not dividended out, then it would have caused a significant increase in the level of equity in the debt equity ratio.
Is there any element of reinsurance surrounding the self-insurance fund?
Not to the best of my knowledge, no.
All right, Mr. Jennings, I will stop there. I think my co-intervener has some questions, and then I will come back if need be.
Thank you.
Good morning, Mr. Jennings.
Good morning.
Please refer to your affidavit dated 26/06/19 and the attachments to that affidavit. This is in the depreciation application.
In the depreciation application?
Yes.
26/06 when?
20/06/19, the 19th of June 2020.
I may not have that with me, I'm afraid. Anyway, but if you go ahead.
All right, I'll read.
Yeah,
I will
if you wouldn't
read
mind.
what's necessary.
Yeah.
Just give me a moment.
Sure. While you're doing that, I'll search and see if I happen to have it. I didn't come with those.
Okay.
Sorry.
Can you confirm in the meantime that you have been involved in the depreciation application throughout the process?
Yes, I have.
Thank you. I read paragraph 5 of that affidavit. In May 2020, we requested Duff and Phelps to determine the annual depreciation and rates of the depreciation electric property of the applicant as of December 31, 2019. 2019 update. A true copy of the 2019 update is annexed hereto, marked Exhibit RJ1. We also requested that this 2019 update include a scenario of capital recovery of all fossil fuel generation by 2020 scenario, a copy of the 2030 scenario. The 2030, that should be 2030, not 2020. The 2030, a copy of the 2030 scenario is annexed here to Mark Exhibit RJ2. And paragraph 7, halfway through, the paragraph says, accordingly, the applicant hereby requests the Fair Trading Commission adopt the updated 2019 depreciation rates which the applicant uses for financial reporting purposes and which themselves have been based on depreciation studies prepared by independent consultants retained by the applicant, and that the applicant be allowed to continue to calculate its depreciation rates using the remaining life method. What are the retirement dates used for financial reporting purposes? Can we find those in any documentation that you've provided?
The retirement dates associated with financial reporting purposes?
Yes.
Yep, that's what we discussed yesterday, I believe, in Schedule I believe.
That's the volume 3?
Yeah, in Volume 3. I'm looking to see if I can locate it here. Yeah, so Schedule I think on page 786. That includes the retirement dates for the generation plant. I have it up there. I don't know if you can see it. And that would also be in the depreciation study that would have been conducted by Mr. Huff that we went through yesterday.
All right, thank you.
You're welcome.
So specifically, what is the company seeking approval of with respect to depreciation for a generation plant? Will it be those dates in table I1?
Well, for me specifically, what we're looking for is approval of the revenue requirement and the tariff associated with it, and the revenue requirement is based on the depreciation, which is based on these retirement dates.
Are you aware that approval of depreciation policy and rates for generation plant was referred to this current hearing? That the Commission specifically said that the company was at liberty to seek approval of depreciation policy and rates for generation plant in this application.
I understand the Commission said that, but I guess the question you asked, I was just answering the question that I understood you to ask, which is what do we want? And as far as I can say, what I would like approval for, what I see here is approval for the revenue requirement used in determining the tariff, and the revenue requirement to me would include the depreciation which was used to determine that revenue requirement.
And the depreciation used to determine that revenue requirement is the depreciation?
It's calculated based on the depreciation included in there, yes.
As far as your affidavit in the depreciation application is concerned,
yes.
Do those rates conform with RJ1 or RJ2? With the attachments to your affidavit.
Again, I don't have it, but if you say they conform, then
I'm not saying they do. I'm asking which one they conform to.
Oh, you mean relative to 2030 dates versus? Oh, well, I mean, you can see here this has 2032 in it and so on, so they don't conform to the 2030 scenario.
All right. Well, you've answered the question as far as the Clean Energy Bridge is concerned. So, Chairman, I'm trying to understand exactly what we're looking at in relation to the request for depreciation for generation plant, the approval, because we have different schedules attached to the application for depreciation. We have something specified in the depreciation in the application for an increasing rates, and this team wants to understand exactly what we're looking at for generation plant depreciation. And so I just want to be certain that the company's request is what is contained in I-1, and that nothing else is presented at any other point when we're looking at what the depreciation policy and rate should be. Can we confirm, can that be confirmed, that that is explicitly what the application is for in relation to depreciation for generation plant in this hearing?
Well, the application is based on, the application is for a tariff. The tariff is with the revenue requirement, and the revenue requirement is based on, includes depreciation, which is based on these dates here.
Chairman, are you satisfied that the commission is certain as to what's being applied for? Because we are not. So we're looking at a depreciation application having been filed previously, and obviously that was focused explicitly on depreciation. Now we're having something bundled into this application, and we want to be certain exactly what we're looking at when it comes to depreciation.
Chair, if I may. The Commission has been clear as to its depreciation ruling and what has been deferred to this hearing. The information filed is the information filed. If at the end of the proceedings, my friend would like to indicate that it was either inadequate, confusing, or otherwise, she can make that application. But the information and the available evidence is what has been filed before the Commission. If the Commission feels at the end that they don't have enough, they don't know what the applicant meant, or that there was some confusion as to the evidence, they will make a ruling. But the evidence is the evidence. It's been available, and the order of the Commission is clear. So I really don't know what this line is supposed to achieve at the end of the day. The intervener is allowed to make an assessment as to the evidence that has been presented and make her submissions to the Commission. If she feels there was inadequacy, she will indicate that.
Ms. Watson, kindly continue.
Thank you. Mr. Jennings, does the company normally base its requested lives on consultants' recommendations? Yes. Would you normally base the...
So I would have said yesterday that the retirement dates are better, questions on retirement date better put to the asset management team. I think they've agreed that we'll have a panel that comes after that can speak to that.
I'm not asking on the specific dates. That question doesn't ask you to opine on the dates. I'm asking you how you go about having those dates determined. This is information that is dealt with in your affidavit, so I expect you to be able to respond to issues covered in your affidavit.
I don't have my affidavit, but I believe that my affidavit also would say that I receive information from the asset management folks, particularly as it relates to retirement dates. I don't know. I certainly know that there are affidavits submitted in that depreciation application that were signed by the asset management folks as well. I'm not trying to be difficult. The reason the table I is in Schedule I, which is signed by someone else, is that the determination of retirement dates is done by someone else.
Mr. Jennings, throughout this discussion on depreciation, interveners have been referred to the 2017 study, the 2019 update, and that affidavit that I'm referring to is in respect of the 2019 update. So we're not just looking at what's in the application, because frankly, if we were, we would not be having this discussion, right, because there is no request for an approval of depreciation in your application. So we do have to revert to the filing in relation to depreciation policy and depreciation rates based on the 2017 study and the 2019 update. So I'd expect you to be prepared to speak to that. That's what we've been directed to.
Chair, the witness has indicated he does not know. I believe he answered the question. Whether the intervener believes he should, I imagine she could indicate.
Mr. Jennings, was a useful life study produced for the Clean Energy Bridge?
To the best of my knowledge, I haven't seen a formal study on the Clean Energy Bridge, no.
But the company asked its depreciation consultants, Duff and Phelps, for a scenario of capital recovery of all fossil fuel generation by 2030. Is that correct? That's in your affidavit.
It is, yes.
Let's see. Why hasn't the company, in similar fashion, produced a useful life study for the Clean Energy Bridge, given its importance?
So typically we do depreciation studies every 5 to 7 years or so. In between the situations that come up, like the acquisition of when we did the solar farm or when we did AMI, and when we've done the Clean Energy Bridge, where a depreciation study isn't formally commissioned, but the same methodology that is used when the depreciation study is done was followed, and they using a remaining life and straight line method is what is used, and the information supplied by the asset management folks with the work that they do they determine and inform their retirement date, and we apply depreciation based on that.
Mr. Jennings, do you have I want to refer you to an interrogatory response filed by the company. That interrogatory response is RB7, response to interrogatories dated, well, I don't have the date, I have the date of the interrogatory. Would you have access to that? It's a response to an interrogatory of Mr. Went.
A response to interrogatory of Mr. Went. You know the date
of Mr. Went's interrogatory? Yes, I can
Or
find
the date that it was responded to?
Just give me a minute.
Sure.
The date of the interrogatories is June 30, 2022. There's no date on the response.
June 30,
As far as I can see.
2022.
Yes.
To Mr. Went.
Yes.
I have something here. RB7.
Yes.
RB7. Yes, I'm with you.
All right. Can you go to the last page of that document, response 17?
Response 17. What are the dates the Ministry of Energy proposed for the retirement of fossil fuel units? Is the Ministry of Energy aware that the Clean Energy Bridge, which is recently installed, is a fossil fuel system?
Yes. You can continue to read the response, please.
Sure. As far as the applicant is aware, the Ministry of Energy, Small Business and Entrepreneurship is aware that Clean Energy Bridge is a fossil fuel plant. The dates the MESB have proposed for the retirement of fossil fuel units are outlined below in table Went-6.
Would you give the date for the proposed date in the table for the retirement of the Clean Energy Bridge?
31st December 2046.
And do you agree, it's a simple calculation, do you agree that that equates to the 25 years that is being used by the company for the Clean Energy Bridge in the application?
2046, 2021. Looks like 25 years to me, yes.
Isn't it true then to say that rather than basing the proposed asset life on your normal mechanism, which is to produce a useful life study, the company is instead dating basing the proposed date on the date shown in this table as proposed by the Ministry of Energy.
I don't know that that's a conclusion I would draw from this, but, and I certainly wouldn't be able to speak to it. What are the dates Ministry of Energy propose retirement of this? I suppose the way the question is worded perhaps may give that impression, but I'm not sure that that is a conclusion I would draw from this.
Can the Ministry of Energy set depreciation policy for the Barbados Light and Power Company?
Can the Ministry of Energy set depreciation for the Barbados Light and Power Company? I don't think that outright they can, but I do think that they are able to influence factors that would influence or inform determination of the retirement dates.
Is there any agreement with the Barbados government with respect to depreciation of fossil fuel assets held by the company?
Agreement as in like a formal agreement that sets out what
Yes,
dates?
formal agreement.
To the best of my knowledge, no.
Has the Fair Trading Commission approved a life for the Clean Energy Bridge?
To the best of my knowledge, no.
Thank you, Mr. Jennings.
You're welcome.
You're finished, Mr. Watson?
We're finished.
Okay.
Until, of course, if there's the panel coming back to sit with Mr. Jennings, any other questions related to depreciation?
Okay. Okay, thank you. Well, we adjourn for 20 minutes. now resume this hearing. The next individual to do the cross-examination of the witness is Mr. Kenneth Wendt. Mr. Wendt has requested to do his cross-examination via Zoom, and we have so decided he's not well today. So could we have the link appear on the screen? Good morning, Mr. Wendt.
Yes, good morning. I'm struggling badly, Mr. Chairman. The AC is hitting me. Is it possible at all, Mr. Chairman, I can go, but is it possible to allow me to reserve and then let Colonel Brown, Intervenor Brown, go if he's ready, and then I will take it up after that?
Okay.
Yes, if you could accommodate me, I'd appreciate that.
Yes, okay. The Barbados Sustainable Energy Cooperative Society Limited, Mr. Brown, you're ready to proceed?
Sir, I'm a soldier, sir.
Okay, please. Thank you.
And my condolences to my brother, Intervenor. Mr. Chairman, can I start with a brief reminder, particularly to my friend, Mr. Jennings, that my constituents are interested in the simplified version of these various complex issues that we're dealing with. So I'm asking him to please start by forgiving me for returning to some of the issues that I'm sure he must by now be tired talking about. So last, ask for forgiveness. Mr. Jennings, in your redirect from your counsel, he started in fact with the question of the tax refund in 2019, which was based on the change in the government tax legislation in 2018 from 15% to 2.65%, resulting in $19 million savings to the company in expenditure going from 2019 going forward. Simple question. Why can the electricity rates, or why have the electricity rate not been automatically reduced when windfalls such as this are experienced by the company?
So the the rate of tax adjustment that happened in 2018 resulted in a one-time gain in 2018 from the remeasurement of the deferred tax liability of the $19 million. That led to a slight over-earning in 2018 of about 1.75% above the allowed rate of return of 10%. And that probably, that would have been followed by under-earning in 2019 and 2020 and 2021. I don't think that the intention is to try and claw back the under-earning for 2020 and 2021 and 2019. So to answer your question, the way the regulation, as I understand it, works is making sure that you earn a reasonable return, and in 2018, I don't think that the remeasurement of tax led to an unreasonable return.
Okay, thank you for that, Mr. Jennings. Are you familiar with the fuel charge adjustment?
I am, so.
And would it be correct to surmise that the intent of that facility is to as closely mirror the actual cost of fuel to customers on a monthly basis as is possible, given the information available to the company?
Yes.
Could you suggest to us why a similar arrangement with the substantive fuel bill is not desirable?
Is not desirable to what, sorry?
Why it is not equally desirable to have as an arrangement with the substantive fuel bill that seeks to equate the actual cost to the company of producing electricity for customers, mirror the cost that is passed on to customers in the same way that you do it with the fuel charge adjustment?
I don't know that it is not desirable.
So are you saying then that it sounds like saying that would be desirable?
I don't think that I I don't think that the company is looking for any sort of windfall or excessive losses. I think the company is looking for a reasonable rate of return on a regular basis, and as far as we can, we try to manage as best as we could to achieve that. I think the practicalities of the regulatory process, I think, have us in the cycle that we're in. But I wouldn't agree that it's not desirable to have a methodology that allows for earning a reasonable return. I think that would be in everyone's interest if we could make sure that the utility typically earns a reasonable return.
Thank you. You see, where in this whole arrangement are the interests other than the company represented? So, for example, you said that the company's interest is to earn their rate of return. When we started, Mr. Blackman agreed that there are a number of key stakeholders in this whole electricity matter, and actually, I think we agree that chief among them are the ratepayers, the customers, the people who actually use your services. Admittedly, the company, and we'll come to this later, but if by the company you're referring to the investors, are significant stakeholders too. But then there's also the government, through the various agencies that interact, and the employees, so there are a number of stakeholders. What mechanism is there to ensure that the interests of the other stakeholders who may be interested in outcomes over and above your rate of return are properly represented? Are you comfortable that that level of representation is occurring at a high level in this kind of significant decision making? Because the same argument can be used, the fuel charge adjustment is equally complex. In fact, some people may argue it's more complex. So to the extent that we do this and do it so well, and customers have come to trust and rely on the fact that as that goes up and down, it is a true reflection of what they're actually paying for. It is difficult to follow that. So I know the chairman is going to ask me to frame that as a question, but let me stop at that point because I think I have come to the conclusion that you don't necessarily agree with that. The next point is this whole question of the structure. I have to tell you, sir, that I am totally confused and not in a position to explain to my constituents what this is all about. You spent a lot of time talking about the structure of the company in terms of who the shareholders are, how dividends and the debt to equity ratio is applied and all that. And I'm going to ask your indulgence to help me to understand so that I can explain this to other people. To start, just let me say very briefly what we've agreed so far. And tell me if I'm wrong in this. We've agreed that the company is a regulated public utility established under an act of the law of Barbados. We agreed that there's a franchise holder authorized by the Ministry of Energy through a license until 2028 to operate this company. And the terms of the lease is that you maintain and upgrade the infrastructure, that was important, and that you operate the system to produce electricity. Now, do you understand the concept? I'm sure you understand the concept of leverage, is that correct? Financial leverage.
I do.
In order for this company, your company, for the Barbados Labour Department to operate, one of the requirements you have is to raise working capital on an annual basis to fund the operations of the company, to upgrade the system, to produce electricity, to pay staff, to settle your loans and all that. You can call that working capital, is that correct?
Working capital, as I understand it, tends to relate to the short-term assets, net assets of the company, which would not necessarily include the long-term capital, fixed capital, such as property, plant, and equipment. But generally speaking, the company does need working capital every.
I hear you, Mr. Jennings, but just let me remind you that my constituents don't like those are big words.
Sorry, I only answering the question that you asked.
Okay, but just tell me if I'm right or wrong. So the company needs to operate, and to do that, you need money on an annual basis. You need to raise this money by various means. And the means that we know of that you can raise the money is either by using your own money that you have, invest the capital, or debt capital. Is that generally correct?
No, there are two sources of capital. One is equity and the other is debt.
You see, you're talking the complex language, equity and debt, that they have to be defined. You can use your own money.
Which is equity.
Okay. Or you can use investor money. Isn't that also
Which
equity?
is debt. Well, I'm assuming that you mean...
I mean the equity part, yeah, the shareholder, the investor's money.
So investors, so you have investor money that can be split between shareholder money and debt provider money. The shareholder money would be equity and the debt provider would be debt.
Right, and there's debt.
Yeah.
The difference, as far as I understand it, and you could tell me if I'm right or wrong, is that debt financing is comparatively cheaper than equity financing. Is that generally correct?
To the best of my understanding, and the chair has cautioned me before, so I'm being careful with it, to the best of my understanding, to certain points of leverage, that is so.
But certainly in the last decade or so, it has...
No, it's not about the timing of it. It is, so at 65, 35, where we are now, 70, 30...
But we haven't got the 65, 30 yet. All I want to know is if it's cheaper for you to borrow money from the bank or to get it from your investors.
Right, and what I'm saying is at the level, it depends on the perceived risk.
Mr. Jennings,
Yeah.
the question he's simply asking, you know when you calculate, when the weighted average cost of capital is calculated,
Yes,
you know in the column that would say cost of debt,
yes.
he's asking you if the amount in that figure for cost of debt is higher or lower than the one for cost of equity.
I understood that part of the question, and at the moment, the cost of debt is lower than the cost of equity.
That's all he's asking.
The qualifier was adding is that may not be so, depending on how deep the equity goes and how deep the debt goes. That was the only point I was saying as well. But I accept the point. At this level, yes.
Okay, great. So, in making a decision on how you're going to finance your capital requirements, the company has to make a decision between, are we going to borrow this money from the bank at typically 2.5%, or are we going to borrow it from ourselves at 10%? Obviously, from the perspective of customers would like to borrow all from the bank at 2% because that's less capital they have to repay. Is that generally correct?
What is generally correct that the customers would like is
From the
borrowed
customer's perspective, it makes more sense to borrow the cheap money from the bank rather than the expensive money from investors.
But that's a point that I'm trying to make, right? There's a point at which, hear me out, there's a point at which if you can't borrow all the money from the bank and have the bank...
I don't want to complicate it. Remember I told that
Mr. Chairman, can the witness be allowed to answer the question? He was just trying to, and Lieutenant Colonel Brown started to talk over him. May the witness be allowed to answer, please. I'm making an objection, sir.
Yeah, sorry. So what I was trying to say is that if you went to borrow all the money from the bank, it's kind of like if you were running you running your own personal finances and you try to borrow everything that you're looking to spend from the bank. The rate that they will charge you for your mortgage might be 5 or 6% now, but if you get up to a significant amount of debt, then they might be looking at far higher rates of debt. So that's the only point that I was making. So it is in the customer's interest, but to a point, and that's I think what the chair was cautioning earlier, that point is the cost of capital expert that comes next can help with that.
Okay, I appreciate that, but
Okay.
That's complicated. We didn't get there yet. We will get to that. The only point, just tell me, is it better to borrow cheap money or expensive money?
It would be better to borrow cheap money.
That is what I should have asked you from the beginning. Now, somebody has to mediate between the interests of investors who tend to be the people making the decision, and the customers who end up paying the costs. Because you have one force trying to use expensive money because they get better dividends, and the other force want cheap money because the expenses incurred on them is fewer.
I'm not sure I agree with that premise. I don't think that the equity supplier is interested in having more expensive money as a source of capital.
Wait, they don't like dividends?
It's the issue is the overall cost to the customer. If I'm selling cars and I have a high cost to produce the cars, then the price for the car makes it expensive to sell.
Mr. Jennings, that applies if you have competition. You don't. So let's move on.
I'm not entirely sure that I agree. But
okay. The point I'm making, though, is that in the industry, the facility used to moderate this behavior is called leverage, where a guiding ratio is established by the regulator that says, here is a guideline as to how your capital is supposed to be split between the cheap debt and the expensive capital in the interest of both the investors and the customers. Is that generally correct?
yes, to my
Okay,
understanding.
right. I think I understand how to ask you these questions. So, on an annual basis, from my reading, so in 2020, the Fair Trading Commission gave a decision that allowed a 10% return on the rate base for Light and Power. Is that correct?
No, 2010.
In 20 what?
Sorry, sorry, maybe I didn't hear the question correctly.
No,
Can you
in
repeat it?
the 2010 ruling, I thought.
Right, sorry, yes, 2010,
Okay.
but I heard you say 2020. I was supposed to say
Okay,
2020.
sorry. But
No, it might be my
Right.
fault.
And that's fairly clear what that means. Now, where I was lost and where I really need your assistance is where the debt to equity ratio that so far we've been talking about this for the whole week, and it has become murky and murky to me, so I'm depending on you to clarify this to me now. Our understanding is that what the Fair Trading Commission ruled in 2010 was that once the Light and Power identified for the year under review the requirements for working capital, 65%, up to 65% of that established requirement could be funded by the investor funds at whatever is the preferred rate of return. But at least 35% must be funded by debt, which we all know was in the region of 2%, which was quite low over the region. In all the discussions and trying to follow your explanation, the truth is this is not. So what I have been hearing instead, and tell me if I'm wrong, if I may be hearing wrong, and maybe you can correct me now, is that the 65-35 relates to the overall company's debt equity ratio, and that somehow you're on a mission to make sure that the overall, not the working capital, but the overall company's debt equity ratio needs to be steered towards 65%. Am I reading it right that this is the way that you've been interpreting it?
Yes, that's correct.
Okay. And in fact, you seem to be saying that the way that you've gone about trying to correct this imbalance is by using dividends, in other words, by reducing equity, giving it to the investors, so that your equity levels come down to make the debt equity ratio closer to 65%. So if I suggested to you that the ruling by the FTC of 65-35 was not a guideline for you to actually aspire to, but a leverage directive that you are required to adhere to in the interest of protecting the cost that you pass on to customers. Am I wrong? So tell me how I'm wrong. How are we wrong in interpreting the FTC decision from 2010 as a directive to the company, just like the 10% return on the base rate was a directive that said, yes, you can do that. Similarly, the debt equity ratio is a directive that said, this is how your working capital can be split in the interest of both the investors and of the customers who will pay the bill. How have I erred in coming to that conclusion?
So, sorry, if you could repeat for me, because I'm trying to follow what you're trying to resolve.
So I'm trying to give you our interpretation of the Fair Trading Commission's ruling from 2010
Right.
in respect of debt equity ratio. We agree that leverage is an industry-wide approach to managing the interest between investors and customers. We agreed that in order to protect the interests of everybody, a directive is a guideline is provided that says here is how you can split and reward your working capital.
Well, I don't know that the FTC issued a guideline about how you split and reward your working capital. What I can say is, much like this application, what the FTC did was the FTC said in setting the tariff, you first have to assess a revenue requirement. So how much money do I need on an annual basis, roughly speaking? And they set that at about $200 million. And they set that at $200 million by saying, so I'm working it backward and then I'll come forward. So they set that by saying you need about $200 million a year in basic revenue to be able to cover your operating expenses and earn a return. And that return is based on what's your total capital employed, not a working capital or not your annual capital. You sit down to say, because you have long-lived assets, so you have at the time you had $500 million of capital invested, and that was both debt and equity that financed those capitals. So you went and you took shareholder money and you funded that rate base, and you went and got debt that funded rate base. And they said a reasonable blend of the debt and the equity would be 65-35. They assessed then a weighted average cost and then multiply that out to get the revenue. And in the same way, in this application, the total rate base, or the total amount of assets that you require, the total amount of investment that we require to get the supply that you're supplying is $825 million. And you're looking to fund that by a split of debt and equity. And we've tried to get the actual debt to equity as close to that notional structure of 65-35. Does that help any?
No, not at all. You've gone back saying what you were saying before.
Mr. Jennings, if I could come in here.
Sure.
And I'm not necessarily speaking for Lieutenant Colonel Brown.
Although you can, sir.
But what I am trying to understand, what I've understood from the question, is that he's saying that the Fair Trading Commission gave you a weighted average cost of capital, or your rate of return, of 10%.
That's correct.
And in calculating that weighted average cost of capital, they use a 65% equity, 35% debt, multiplied by the respective cost of equity and the respective cost of debt. So my understanding, he said they did not give you a directive to reduce your equity to 65%, but that the 65-35 ratio was used in coming up with the weighted average cost of capital, which they approved at 10%. I think that is how I'm understanding the question, and not that you were given a directive to reduce your equity from 80 to 65. I think that is more what I am understanding the question to be asking.
If the question is, were we given a directive to reduce it, then I agree. The answer is no, we were not given a directive to reduce it. Yeah, right. I agree.
Sir, our concern is, and maybe Mr. Jennings could actually allay that concern, is that the equity that is, Mr. Jennings, I know I have to ask questions, so would you agree that the actual income of Lighting Power is on average 25% of the revenue collected?
Would I agree that the average...
That on average, over the last, since the last rate hearing, the average income on an annual basis has been in the region of 25% of the total revenue collected, not including fuel. Not including fuel,
so the base revenue.
Yeah,
I would have to do the calculation, but it doesn't sound...
2.55 billion net
I would take your calculation.
Calculation. Would you say that is an unreasonable level of income, of net income?
No, I would not say that.
In fact, it is actually quite impressive.
No, well, not based on
so if you were to look at some comparative figures, I think you But let's not be done.
Again, you're taking me then towards an appropriate cost of equity,
Okay,
and
fair
that
enough.
is
That's,
something.
I withdraw that. I withdraw that. Our understanding is, and tell me where I'm wrong with this, is that the intent of this income is largely to fund. Remember, we said that when you take up the lease for a regulated public utility, the very first responsibility you have is to maintain the infrastructure that supports that essential service in the country. The reason why there's a good level of income is to facilitate the build-out of that infrastructure. So that, and this is why we're concerned about the idea that large sections of retained earnings should be targeted for dividends rather than infrastructural investments. It is a philosophical point that actually needs to be resolved. And let me tell you why that is important. Again,
Chair,
So the question,
are you aware, and if you're not, I can give you the figures too, that of the 25% revenue that has average for income, do you have any idea of the percentage that has been paid in dividends? Of that 25%?
You mean what percentage of dividend was paid over the period from 2010
What percentage of
to
income has been paid in
2020?
dividends?
Well, I know that the application says that over the period, 86% of earnings was paid over as dividend. But like I said, it's again geared toward making sure that you get to a debt to equity ratio that matches the notional one.
No, okay, the first, but you answered the question already. You don't have to explain why, because it is 86%.
Yeah.
And the truth is, do you understand why we would be concerned that such a large percentage of the income that is meant to be reinvested to make sure that we continue to have a robust electrical infrastructure is instead being used to equalize this 65, this concept that you've been discussing?
Because as we started off, the greater the proportion of debt in the debt to equity structure, the less expensive the cost of capital required is, which means the less amount of money customers have to pay.
You're getting back into the area where it becomes too complicated for me. Are you concerned that what we have is a situation where directors actually have the capacity to make decisions that benefit themselves in the whole area of deciding how income is actually distributed, to the exclusion of all of the other stakeholders? Is that an area of concern for you as the person responsible for the finances of the company?
Sorry, can you say that again?
So we have a situation where these decisions,
just phrase the question.
Are you comfortable with the current structure that allows the company, as one of the key stakeholders that is represented on the board, to make these decisions like this that impact on all of the other stakeholders to the exclusion of all the other stakeholders? Are you comfortable with that as the person responsible for explaining the finances of the organization?
Sorry, what? I don't think it is to the exclusion of the other stakeholders.
So could you tell me how they have a role in making?
Well, we have a regulator that regulates what we're allowed to charge, what price we charge to customers. We have a regulator that assesses prudence and determines what's a reasonable cost of capital. We have a Ministry of Energy that sets the policy and direction for what is happening. I don't think it is to the exclusion of stakeholders. So
am I wrong in? I actually was under the impression that the Fair Trading Commission was meant to be impartial and not to take sides, so they're really not going to quarrel you. And in terms of the ministry, you mean the ministry here that is my fellow intervener?
Why?
That obviously have concerns with what is actually going on?
Mr. Brown and Mr. Jennings, let us just make a statement in respect to the constant reference that Mr. Jennings is making in his testimony that may be erroneous.
we're just concerned that Mr. Jennings keeps stating what the role of the Fair Trading Commission is, what we have done with the BLPC, what the Fair Trading Commission was thinking when they made decisions, which is not correct. And it would be appreciated if he would stop doing the same throughout his testimony. Because if he cannot speak to his own experts, he cannot speak to what is in the mind of the Commission.
Yes. Chair, just for clarity, and it may be that I was not paying good attention at the time, I do not recall the witness making any assessment of what the Fair Trading Commission was thinking. So could you, and I imagine it may also help the witness so we don't cross the line, what specifically are you referencing?
It would have been previous. He also spoke, it's happened several times, but most recently is when he spoke about what was in the mind of the Commission when we gave the 2010 decision and what we took into consideration.
The difficulty here, Chair, may be that a response is normally conceptualized in relation to the question as asked. When Mr. Jennings makes a reference to the decision, I assume he's referencing the actual provisions of the decision. He cannot be referencing the mind of the Commission. And I do note that I indicated at the time that in re-examination I will carry him to the specific paragraph. So I take the notation from Commissioner Martinez, and I will instruct Mr. Jennings to be careful in his responses. But I would just also ask that in the assessment, please note that referencing decisions or matters that have been ordered on is not necessarily an assessment of the mindset of the Commission.
Mr. Brown, could you continue?
Certainly, sir. So can we move on, Mr. Jennings, to another of the assertions that you made in your affidavit? You raised the concern about the BLPC's inability to raise funds unless the profitability is, unless the rates are approved, so that do you stand by this assertion?
I do.
Could you explain how you can have issues with attracting funds when the average payout on your shareholders' holdings over the last 10 years have been in the region of 24%?
Sorry, the average payout of what, sorry?
Yeah, based on the dividends held and based on the shares held and the dividends paid, it's 24%. How have you divided it? Well, how have I divided it? I may not be that good at math.
Sorry, the average...
In other words, I'm suggesting to you that shareholders of the Barbados Light and Power Company have had an outstandingly successful number of years. So it is difficult to understand how you can say that it will be difficult in raising funds. Traditionally, companies that pay good return on shares have an abundance of people seeking to buy shares so they can benefit from that. Is that not the case?
So the return that would have been earned over the period would have been closer to the approved 10% up to 2017 or so, and from 2018 without the effective tax it would have been 8 in 2019. As I said earlier today, in 2020 we're looking at a return of 3%, around between 3 and 4%, sorry, and 2021 similarly. So the point is, without a reasonable rate of return, and when not earning a reasonable rate of return, being able to raise debt at reasonable rates is challenged.
Okay,
Mr. Jennings,
testimony.
I don't think the question was on the rate of return. I think the question was more on the dividend payout ratio.
The return on dividends is what I'm talking about.
Sorry, meaning...
But would you like me to give you the exact figures? Because I could probably do that. So we've established that over the period since the last rate case, $538 million in dividends have been paid over that 13-year period?
That is correct, yes.
Do you agree that the shareholding in the Barbados Light and Power Company is $200 million?
The equity in Barbados Light and Power Company is $500 million.
I'm not talking about the equity in Barbados, I'm talking about the shareholding by
stated,
investors. It's a completely different thing.
You mean the stated share capital?
I'm talking about the
company?
share capital held by investors. According to your audited financial statements. You have investor share capital of $200 million. Dividends are paid on shares, isn't it?
Mr. Brown, just allow Mr. Jennings to answer the questions. So I think he was asking what is the stated capital and not what is the shareholders' equity.
I understand. The stated capital is $200 million.
Thank you. And the dividends paid, you agree, $538 million.
I agree.
Can you find a way to divide that it doesn't come to 24% per year?
I cannot.
Me neither, and I used to teach math.
I understand.
However, so in those circumstances,
Mr. Chairman.
Oh, okay, Mr. Brown.
Oh, sorry.
However, the return as allowed in the, as referenced in the decision, is on total equity and not on share capital. So I think it is inappropriate to look at the income as a percentage of stated capital. I think that is misleading. The return on equity is what is assessed, and the return on equity allowed in the last decision was 12.75%, and we've not got there, certainly not in the recent past.
Okay, thank you for that. I understand. What you just did for me is to clarify where we differ. So let me see if I could get you to help me to see how I'm wrong. Okay. So you're referencing the equity of the entity called the Barbados Light and Power Company Limited. Is that correct?
I am.
Good. That's not what I'm talking about. I'm talking about the investments in the entity called Barbados Light and Power Company Limited by your investors. That investment is $200 million in shares. Is that correct?
The stated capital is $200 million.
The capital invested.
The stated value of the share capital is $200 million.
Thank you very much. So let me ask you a question. As you know, I represent the Co-op Energy, which is the energy arm of the local cooperative movement. Let us say, and just being facetious, that we were to the co-op movement of Barbados.
Mr. Brown.
This is the question, sir.
Okay.
So let us say that the co-op movement was to buy half of those shares. Are you saying that that will automatically give us ownership of half of the $800 million asset of Light and Power? So we buy half the shares for $100 million, so we now own half of your invested capital. Does that mean that the co-op movement will then own half of your overall assets?
If the co-op were to purchase half of the stated capital of BLPC, they will own half of the assets in BLPC.
No. BLPC will still own all of the. BLPC isn't BLPC a body corporate?
Sorry, I misunderstood your question. Yeah, okay. So if the co-op purchases half of the shareholding, then they will own half of the shareholding. No, you have just. I don't need to ask you any more questions because this is where I agree 100% with that, and thank you for that answer. Why, from your perspective as a financial controller, are the shares of the Barbados Light and Power Company not on the market, fetching the true value that they deserve? Is there a good reason for that?
Mr. Brown, I don't think that
Well, so I got to ask somebody, and he closest by to the money.
It is, Chair, it is inappropriate to ask this witness, yes, but more importantly for the Commission, is irrelevant for the purposes of your assessment.
Sir, the witness has asserted that one of the reasons why they need to get this rate increase is because in the absence of that, they will not be able to raise funds. I can't think of anything more pertinent than the fact that the key avenue of raising capital, sir, is the capital market. And here is an organization whose funds...
So, is the question you're asking him as to how could a company raise capital? Is that the question you want to...
No, sir. I want to know, how could you complain about not raising capital when you don't allow people to put capital into the company?
But we're just also indicating that the witness would not be in a position to
Oh,
answer.
but that would be your answer, sir. If he said that, I would move on.
Oh, sorry.
I'm sure that somebody that can answer will come.
No, I'm just trying to indicate, I thought you were looking at the challenges in being able to raise capital, that as opposed to the other question that you were going with.
Okay, thank you, sir. But no, because I actually think that Lightning Brown could quite easily raise capital, and they think that because my organization would be quite willing to put a couple $100 million into it if we were allowed to do so, sir. So can I continue?
Yeah, continue, Mr. Brown.
Are you concerned, Mr. Jennings, that we have a situation with the BLPC where your customers at the one end have no alternative but to buy electrical services from your company, and at the other end there's no market trading of the share capital of the company, so that you have protection on the you're protected from the sales from the competition, unlike even some other utilities in Barbados, like telecommunications, for example. But your stakeholders, your capital investors are also protected from competition. Is that a typical position in the industry, you think, from your experience?
Sorry, I'm not sure I follow the question.
Okay,
Yeah.
everybody in Barbados has to buy electricity from Lightning Power. Is that true?
Well, yes, in effect.
Right. So your sales are guaranteed. Nobody in Barbados is currently allowed to invest in the ownership of Lightning Power at the capital level. Is that correct?
So the shares are not publicly traded currently, that's correct.
So I'm right. Okay, thanks. Since the last rate case, how much capital has been invested into the company by the current shareholders?
I think we responded in through our outreach to that. We said that over the period, $774 million was invested in property, plant, and equipment over the period.
Well, that may be true, but that's not the question I have.
Sorry.
I want to know how much was invested by the current investors, the current shareholders.
You mean how much additional equity would have been
No,
raised?
how much, not additional, how much any equity would have been invested in the company since 2010?
So we haven't raised any equity. As I said earlier, we've actually been trying to reduce equity.
So I can take that to be zero.
That is correct, yes.
Right. During that same period, do you have any idea of how much revenue has been paid into the company by ordinary customers in Barbados?
Yep, it would be in the order of about $190 million a year.
And if you add
On
it
basic revenue.
$2.55 billion, not including the fuel charge. And if you include the fuel charge, it would be $6.3 billion. Is that correct?
And they would have enjoyed a really safe and reliable service as a result of that.
We can argue about that, but that's a different topic. I think.
I understand.
Mr. Brown.
Oh, sorry, sir. But so he started it. But you've actually clarified that. I actually understand it a lot better. I thank you for that. So can I move on now to the next item that your attorney led you, we directed you to, and that is the self-insurance fund. And I know that you must be tired talking about this now. I promise you this is the last time we can talk about it. Because, Chair, can the witness give me permission to just outline the position, and then at the end he can say, well, you're talking foolishness, Trevor, or that he agrees? Is that a reasonable approach, or you're not going to entertain that?
Once you phrase it in a question.
But sir, the question mark is going to come at the end, just remember that.
Right, okay.
So do you agree with the following, Mr. Jennings? So we have this self-insurance fund that was started in 1983 because there were difficulty at the time after Hurricane Andrew and all that in getting reinsurance, just like it's happening now with your third-party insurance, by the way. And the company innovatively and creatively started a self-insurance fund, which grew up to 1998 into a trust. And we all admit that during that period, the rates did not cover the full cost of that. So the way that Mr. Dackman put it, and I understand what he's saying, is that the investors at the time would have made a sacrifice in terms of dividends to fund the building of that insurance fund. Is that generally correct so far?
To the best of my knowledge, yes.
Okay. Now, what happened in 2011 of significance, do you recall?
Sorry, not sure what you're relating
In 2011, Emira bought all the shares in Light Income. Before 2011, I think it was Lucady and a bunch of other shareholders made decisions in Emira, in Light Power. Now, when the shares were sold in 2011, am I correct in suggesting to you that the purchasers of those shares would have bought the shares at a price that took into consideration everything that happened before 2011? In other words, had those dividends been much higher, the share price would obviously have been higher. The fact that the previous shareholders had to take hits in dividend payouts would have impacted the price they would have got for the shares. Point being, I want to suggest to you that when Emira bought the shares in 2011, they bought a going concern and they did not carry forward any benefits or liabilities for what happened before. So tales and stories to the effect that previous shareholders would have made contributions that then somehow needed to be paid back to somebody. Would you agree that there can be no basis to this if provided that the share price paid in 2011 would have taken into consideration the realities of what led to 2011, and the new shareholders would be required to start at 2011 when they bought the shares and move forward?
Chair, the witness isn't in a position to say what was in the mind of the shareholder when he bought.
No, that's how it works.
Well, Lieutenant Brown, it seems, can speak for the Emir, but I'm saying this witness can't speak for what was in the shareholder's mind when they bought shares.
Mr. Chairman, can you respond?
You could phrase a question for the witness that he could answer.
Typically, Mr. Jennings, and you would know this because this is your area of strength, when shares change hands, the purchaser of the share would buy the shares at the value at the time, what they're worth at the time they bought. Is that correct or not? This is why the value of shares go up and down.
Just let him answer that question and then.
Okay.
Sorry, so the question is typically if shares would be sold at a price at trade at the time?
That's
To
right.
the best of my knowledge, publicly listed shares would trade at a price.
Exactly. So your expectation is that if shares were bought in 2011, the price paid for those shares would have taken into consideration the value of the shares at 2011, given all the ups and downs that they would have endured in the decades previously. Is that correct?
If shares were bought in 2011, I imagine that they would represent the value at 2011, yes.
Thank you very much. So I should have asked that in the first beginning. I apologize for that. So therefore, in 2016, what could possibly have been the justification? And these new shareholders who would have benefited from the price that they paid in 2011 for the shares, making claims for things that happened in 1983 and 19...
Sir, the witness is not able to say what's the justification for the shareholders.
Okay, I can refer to
and
that.
There's been no evidence that shareholders made a claim. So there's a false premise and there's a request for him to answer something which he cannot speak to.
I apologize for that, Mr. I withdraw it. On what basis then can the company now seek to justify that $100 million withdrawal in 2016 on the grounds of something that happened prior to 2011?
The witness cannot speak to the company's decision. It was money within a trust, and I believe a trustee has spoken to the factors informing the decision.
So you're saying the witness don't know, he can just say that? I'm quite happy if Mr. Jennings is going to say that he's not aware of sensible reason for that, because I'm not either.
So, Mr. Brown, you can move on.
But do I get answer to that question, sir? Even if it is, I don't know?
My position is that the witness cannot speak to the issue because it's not within his purview. And we already have the evidence on record as to what informed the decision from someone who had such purview.
So I don't have the luxury of a transcript, immediate transcript like Mr. Ali.
The trustee had spoken to that matter.
No, sir, but the question I asked was Mr. Jennings' opinion about the justification of such a transaction. From my memory, that I may not have said like that because I tend to say things on the spur of the moment. But I'm interested in an expert.
Lieutenant Colonel, as he said, he may have said it on the spur of the moment. He didn't ask Mr. Jennings' opinion. He asked what was the justification.
Okay, I will take your word for it, and I will continue as you directed, Mr. Chairman.
Yes.
Okay, so I think that I have clarified the concerns that we have on that, and I can move on to the next item, which is the question of, we spoke briefly about this on the whole question of the test year. So the question for you, Mr. Jennings, and I just want just your position on it. After hearing the general disagreement that has been expressed at many levels about the unusual nature of 2020, would you support a call for a more acceptable test year, or are you convinced that you continue to be convinced that this is a good choice of a test year?
I believe the test year to be reasonable.
Would you agree that in the light of the projected chaotic changes that we can expect in the energy market, particularly in Barbados because of the Barbados National Energy Policy, that more regular reviews should be considered in concordance with Section 15.1 of the Utilities Regulation Act, because things are changing so drastically, and we seem likely to be in for even more chaotic years? Do you think we should continue with the same process that we've had for the last number of decades?
I believe reviews should be conducted as warranted.
As warranted, okay. Yes. You're aware that your sister company, Nova Scotia Power, do annual rate reviews, and in fact, you can actually see the reviews for the last 10 years. Are you aware of that, or are you not aware of that?
I'm not aware.
Chair, I believe this line of questioning was put to the managing director, including what the sister company does. I don't know that this will assist the commission any further in its assessment.
What drives the approved rate on return? In other words, from my recollection, and you can tell me if I'm wrong, what happened in 2009 is that the company applied for a rate of, a return of 10.34 or something like that, and the Fair Trading Commission approved 10%. What drives that? What drives that figure, that percentage figure that you determine and that you have actually indicated now in your application to be a reasonable return for the company? What are the factors that actually drive that?
Sorry, you're asking for what are the components that
yeah,
make
how do you come up with that figure?
cost of capital?
Do you look at other utilities? Is it a number you calculate? How do you arrive at that figure?
That's a subject of a study. The expert will be coming after me who can explain how that is done.
Oh, okay, okay. I want to move on to just something that you said that I actually like a lot, and I want in your deposition, in your memo, the first item you actually identified that. Let me, if I could read it. Rate base is the value of the utility plant financed by the company and investors that is prudently incurred and used and useful in public service, and is valued on the original or historic cost basis. Prudently incurred. I actually think that is extremely well said, and I agree with that. So I wanted to move on to ask you a couple of things. Now, we had some, I'm not going to be long on this because previous interveners actually touched on it, but there are just a couple areas that I want to clarify in my attempt to simplify it. How is it prudent to invest in this steam plant and to incur an actual depreciation charge on customers of $4.5 million in the test year alone, and for 3 additional years, to get up to extend the life of a plant that really is operating way, way, way below its original 20 megawatt capacity. Would you say that that is prudent? Or is that outside, should I leave that for the technical people?
I believe that is better with the technical folks, yes.
Happy to do that. Are you familiar with the AMI meter project?
I have general awareness of it, yes.
You're aware that this adds $2.5 million per year to customers' bill?
I believe they...
From the depreciation study, if you, look,
Right.
if you add the software and the hardware, it's 2.5. The charges for 2020 alone is $2.5 million. So, how does this, what benefits does this bring to customers? So what is it? Customers...
Chair, the managing director has already spoken to the benefits of the investment, why it was done, and what should accrue to customers.
Mr. Chairman, you see my age? I can't remember what somebody else here before now, and I don't have the resources that Mr. Allen has. Anyway, if I will take the time and check my records and see what the answer is to that. You're aware that the depreciation rate for the AMI is something like 5.37%? From the study, if you look at the study.
Yep. Yes.
Versus 1.86% for traditional meters?
Well, that would be for the remaining additional meters.
But the typical, so could you give me an idea what the typical depreciation rate for a traditional meter is?
I wouldn't have that in front of me. And
No, okay, fair enough. But that's reasonable. The other thing on this whole question of prudence is, I noted this, and I'm sure I will defer this to the technical people, but this is related to the underground cables, the charge for underground cables. It is difficult for me to understand, and I'm sure you must have asked the question as the financial controller, why the depreciation rate for underground cables will be at 3, and for overhead lines and equipment will be 2.8. It is intuitively, it is something that I would need to get clarified, but I think I would be happy to pass that on to the technical.
Well, I mean, you could ask them, but that is effectively redoing the depreciation study that would have been done and would have been completed prior to this, and this would have been a rate that was approved as part of that study. I mean, you could look back at what informed it. I think it's all there. It might help you resolve in your mind what the issue is.
Oh, so you're saying that, for example, there will be a schedule with the various cables and the age and and all that. That can be.
I'm saying there's a lot of information with the depreciation hearing that went by and what was already approved. I'm saying you can look at that. That may help.
Granted, I accept that and I appreciate that. Just 2 other questions, and I think I can wrap up. So, given the situation that we've actually outlined for the way that the company works, what is there now that would give assurance once a new rate is given, that we wouldn't just see an increase in the percentage of the additional income generated being paid as dividends in order to equalize the equity concept that you have been articulating? Is there something in place that would tell us that this additional rate is going to make sure that the funds filter into the retained earnings of the company and become available to you as the chief financial officer to fund the operations of Barbados Light and Power Company rather than to increase dividends to shareholders? What is in place to actually guarantee that?
So I don't think that there's anything that guarantees that. I think that you look at the 5-year forecast that we've put forward, and that shows how the rate is intended to be used. There's a significant amount of expansion that needs to be done, and that requires both the raising of funding for it and the servicing of that funding both to debt and equity providers as well, while also trying to balance the same debt to equity ratio to make sure that, to use your words, if we do have to come back, we have a debt equity ratio that is in the interest of customers.
Well, Mr. Jennings, you know that I'm an old man, right? You recall that in 2010, when the last rates were given, the 5-year forecast projected that new generation plant will be in that there'll be fuel savings in the region of $30 million per year. That, well, I mean, it was great.
Yeah, also had
Certainly, we're not ask the commission to do the same thing all over again. I mean, surely there must be something more reliable that, from your perspective, that will make you comfortable that once these rates are given, the resources made available becomes available to you so that you can actually properly fund the operations of Barbados Leisure Corp. And you're saying that you cannot guarantee that.
I'm saying I can't guarantee that.
Thank you very much. We heard this morning in response to questions from intervener David that there's a very interesting BLPC incentive scheme that is designed to reward staff for the initiative set by the company, and by the company I mean by the investors. Are you concerned that this incentive scheme could? I withdraw that question, Mr. Chairman. I think I'll close at that point. Thank you, Mr. Chairman.
Yeah, thank you, Lieutenant Colonel Brown. Mr. Jennings, if I understand your testimony correctly, you have stated that the mechanism which the company controls its capital structure is through dividends to shareholders, which essentially is equivalent to the return on equity. Is that correct?
So, not sure, let me make sure I'm following the question and answering properly. So the mechanism that is used to manage the debt equity structure, one of the levers that is used there is dividends, yes.
One?
Well, yeah.
Is there another one?
Also, by looking to borrow additional funding for growth and for new investment would be another lever. So if you had a situation, for instance, where you had additional plant to be put into service, borrowing that money might help balance the debt equity as well, but both are considered.
Okay. And the amount that you're making a return on to pay the debt and equity providers is based primarily on the utilities net investment in plant. Is that correct?
It is based on rate base, yes.
Okay. So over time, as a given investment in plant assets ages, the related accumulated depreciation balance would also grow.
Yes.
And depending on the regulatory of these rate cases, the return the company is making on that plant theoretically would reduce. Is that correct?
If you don't have reinvestment and you don't end up with putting more cost into the plant, as the accumulated depreciation grows, the rate base will reduce. And sorry, what was the second part of your question?
All right, let me give it another way. Let's say, for example, we apply the 10% weighted average cost of capital to an item of plant.
Yes.
And that plant was purchased brand new for $1 million. You would have a return of 100,000.
Yes.
Right. Now, if that same item of plant is depreciated to a net book value of 500,000, a 10% return would only be 50,000.
That's correct, yes.
Okay. So would you agree that ignoring other items in the rate base, the company's return on invested capital on net assets, net plant assets, or to put in other words, that the weighted average cost of capital, which represents a return on equity, and the cost of debt is applied primarily to the net asset, net plant asset value?
Yes.
Okay. So we've already discussed that the net plant represents the company's investment in plant less the accumulated depreciation. Through what mechanism on the income statement is the expense related to accumulated depreciation recognized?
It's in the expenses and depreciation.
Okay, so that would be depreciation expense.
The depreciation expense, that's correct, yes.
So does depreciation expense represent an actual cash outflow for the company?
No, it does not.
Okay. Is the depreciation expense recovered in the rates?
It is.
Okay. So if the company earns on the net plant assets and also on depreciation expense, which is recovered in the rates, representing the accumulation of depreciation, would it be fair to say that the depreciation expense included in the rates represents a return of capital to the providers of the capital based on the net investment at that point in time?
It would be, provided it wasn't being reinvested.
Okay. So if I go back to my simplified example, an item of plant costing $1 million, that is halfway depreciated at that point, the company is earning on the remaining $500,000 of net plant, as $500,000 of their original investment in that plant have been returned to capital providers through the mechanism of depreciation expense.
Yep. Provided, of course, it wasn't recapitalized or the fully depreciated parts retired and then replaced.
Okay. So if I understand from this simplified example, ignores items such as the growth in capital investment over a given period. If we lower the accumulated depreciation balance to that point to $300,000 from the $500,000, and we reset the depreciation rates based on the net plan, would that result in a $200,000 difference being recovered from the ratepayers again?
Sorry, say that. Go give me that again, please. Sorry.
Right. So remember that you're charging the depreciation expense.
Yes.
So as we lower the net asset value,
Yes.
so if it is lowered from 500,000 down to 300,000,
Yes.
and we reset the depreciation rates based on the net plant amount, so would that 200,000 difference would that not be recovered by the ratepayers again?
If you reset the rate based on the
Remember,
200,000. Sorry,
no,
go ahead.
No, I'm saying, remember, I'm just asking you the question in relation to the depreciation expense,
Yes.
which we are taking in the determination of the overall revenue requirement.
Right.
Looking at the income statement,
Yes.
so how do you calculate, or what is your understanding how we calculate the actual rate?
So how you calculate the actual rate would be the assets into sort of rate base multiplied by the appropriate return, and you add to that the reasonable expenses associated, and that gives you the revenue requirement.
Right. So as
Yeah.
Mr. Brown is asking for it in a simplified form,
I see.
right? So if you can give me your understanding in this simplified form.
Yeah.
So we have two components. One component is the plant, the book value of the plant assets.
Yes.
And you multiply that by
The rate of return.
the rate of return.
Yeah. And that
So
gives you the income that you need.
Okay.
Yeah.
That gives you, right. So we are saying that included in that calculation, which is based on your net plant assets,
Yes.
but then you're also having depreciation expense
Yes.
as a revenue requirement. But the depreciation expense is not a cash flow.
No, it's not a cash flow, that's correct.
So we are asking if you don't think to some extent that may be some sort of double recovery.
No, well, if you didn't have any further fixed asset additions, then you would be returning you'd be returning that money to the shareholder. That would be, to your earlier question, would be return of capital. So if you keep it really simple, you go and you buy a car, and you're going to use that car as a taxi, and every year you get back, you depreciate that, you recover from, in essence, asking the people who use the car, the people who use it as a taxi, the customers of the taxi who take the taxi ride, you're asking them to give you, say you spend $100 on a car and you're looking for $20 a year from them toward paying for the original cost of that car, and then the return as well. Assuming that you're not replacing that car, retiring the components of that car and keeping it going, then you would return that capital to the taxi owner, the taxi driver every year. That, to me, makes sense. Where I think this distinction happens here is if you are planning to keep that car, or you're working with that car, and you have to you have to overhaul it and re-maintain it. Then when you get the $20 in from the taxpayer in that year, you then have to maybe change the transmission, or you have to do other bits and bobs of retiring the pieces that exist and put it back. So in a simplified way, yes, but then when you have the ongoing recapitalization of the plant, you kind of end up with it being replaced all the time. So I don't think it is as simple as you have a double earning.
Okay, because I'm just trying to get an understanding in relation to this, that if there is no further investment, as you're saying,
Yes.
that at the particular point in time when this determination is made, let's say
Yes.
you're calculating your weighted average cost of capital, which is your rate of return on the net book value of the assets at that particular point in time,
Yeah.
right?
That's
and
correct.
then there's also the revenue requirement.
Yeah.
And so all I'm saying is that if, as we continue to depreciate the plant, that you would have included in your original rate base, let's say I'm using my 500,000, that having the 500,000, 10% is 50,000.
Yes.
But as that continues to drop as a
Then
result of accumulated depreciation, then you would have been earning, you should be earning less. But
Well, I think how that would work is if you just keep it as simple as just one asset and you're not replacing, then every year you would give back the equity holder, you would give back the person who bought the car, the money, and then you look at that the rate of return will continue to come down. So yes, you're right, you would have a declining asset amount, we also have a declining equity amount, or a declining invested amount as well.
right, because I'm just trying to,
Yeah, because if you have $100 and you start with a car and you're depreciating it $20 a year, and you're not doing anything more with the car, the $100 in capital that you would have put in as well, you give that back to the shareholder every year as well, and you come down, both the asset and the car will come down as well.
right. So I'm saying remember you're making the statement that you're giving it back to the shareholder.
Yes.
But remember, we're saying that it would have been included in the rate base. So my question would be, are you looking to balance, let's say, the change in your accumulated depreciation with your additional investments? Because
Correct.
that's the only way that,
Correct, and that's what you do. That's what we do. We monitor the rate base and how much rate base you have, right? And that's a big chunk of the reason for this application now. The rate base on the last occasion was $500 million, and now it's $825 million. So the tariff for that, the tariff required for the revenue for a $500 million investment is very different to the tariff required for an $800 million investment.
but right, and the point I'm also making to you that during that time you would have also included depreciation expense,
Yes.
which is a non-cash expense,
Yes.
that would have been included in your revenue requirement.
Yes, and over that period, so the 800 million, so the 500 million that you would have had in 2010, you would have depreciated that, yes. Or you would have also put in additional, you would have done other work to replace. So when you put a pole, you got to replace the pole. When you put cables, you got to replace cables. So that 500 million gets replaced. So it's not like the 500 depreciated amount is now being returned to shareholders. You're replacing that capital pretty much every year. And then in addition to that, now you're growing it to the 800 million.
Right. So what I'm saying is, so we have to look at the growth or,
Yes.
or further investments,
Yes.
but we need to balance that against what you would have been claiming as your depreciation expense.
Yes. You do have to balance both, yes, you do.
Okay. All right. So, does the Barbados Light and Power intend to maintain any alignment of its books and financial statements in relation to this whole question where you have your depreciation for regulatory purposes versus your depreciation for IFRS?
Chair, I would like very much to be able to.
Okay. Yeah, there was one other question that and it's going back to this whole question that keeps in terms, but I'm trying to remember you would have presented yesterday. There was a schedule which you were showing your cash flow and your cash payments over the next 5 years. I'm trying to remember, you had presented it on the screen, but I made a note.
Cash payments over 5 years?
Yes, it was your cash flow statement. I'm trying to,
forecast?
cash forecast. Could you pull it up for me, please? I made a note, but I just wanted to.
This is on the existing tariffs or with the proposed tariffs?
It was a cash forecast. It was a cash forecast.
Right.
I'm sorry that I can't reference the exact page right now, but it was a cash forecast.
This here?
Go down, scroll up, scroll. Yes, this one here. Right. So scroll a little lower, and I want to look at the cash flows used from financing activities. Right. This is the one because I keep hearing the statement that you are realigning your capital structure through dividend payments. That is your testimony.
And borrowings, yeah.
Mm-hmm. So you're stopped. I note that there's no provision made in here, so we take it that according to this that you would have reached that optimal situation.
Sorry, so this is the cash flow. Okay, so this is the cash flow on existing rates. So this is what would happen if we weren't able to get an adjustment. And what this shows is that we end up having to try to borrow significant amounts of money and in some years even get to negative. So this is a requirement that we have to do.
So I'm just...
Sorry, I was just going to show you the one with the proposed rates.
Okay,
that
okay.
one is perhaps the one that is more meaningful.
Okay. Okay.
So this is what it shows.
Okay. Okay, so if you get the rate increase, you will be able to continue to make dividend payments
to satisfy the capital.
Okay. Okay. So, okay. Thank you, Mr. Jennings, and we will break for lunch. So we'll resume at 2. That was very technical. I'm showing that we Okay, now resume after our lunch recess, and we continue with the cross-examination of Mr. Jennings. Mr. Jennings, I would like to direct your attention to page 684 of the application.
Yes, I'm here.
Yes. And I'm looking in particular to paragraph 23.
Yes.
Okay. Are you aware of any analysis or studies that demonstrate that the use of a 45-day rule actually reasonably reflects the utility cash working capital needs? And if so, can you provide them?
So I don't have any analysis that supports that. What I do know is that on the last occasion that we filed with a 45-day rule, using the 45-day rule, and we did the application on a similar basis.
Okay. Well, are you aware that some regulatory agencies use it and it has also been explicitly rejected by others? Are you aware?
I saw in an interrogatory and a submission that, but I have not been able to check it myself, no.
Does the Barbados Light and Power, any of your affiliate, regularly prepare lag lead studies for the Barbados Light and Power Company?
So the lead lag study has not been done by Light and Power. Light and Power has not done one. I don't know if any have been done by any of the other group companies.
Any reasons why no lag lead studies have been conducted here?
Well, we did not, to be honest with you, I only heard about it when I saw the submission by one of the interveners, and one wasn't done before. And like I said, in the past we used the 45-day rule, and it seemed to provide a conservative estimate of the working capital. If you look at what our working capital is, given the age of receivables and the like, I think it results in a relatively conservative estimate of working capital, but we have not done a lead lag study, no.
So could you describe any metrics that you use to track and analyze your financing requirements with respect to the cash working capital?
Yeah, I can. For our accounts receivable, we track the days outstanding, and on average, right now, I think that's around about 45 days, generally speaking. And that's just on the accounts receivable. It doesn't include the typical prepaid expenses as well. We do have, sorry, we don't have any metrics. I'm just sticking to your question. We don't have any metrics on measuring prepayments as such, no.
Okay, only on your accounts receivable.
Accounts receivable.
That's the only component of your cash working capital.
No, well, that's where I was going with it. I was going to say that we also have prepaid expenses. So we have things like, insurance that we pay upfront. So you have to fund that once in a year. You have to have the capital to be able to pay that premium upfront, and then you have to recognize that over the period. You also have land tax, license fees. You have a number of payments that are made once a year and treated as prepaid expenses, and those factor into the working capital as well.
You mentioned the whole question of prepayments, and there would also be the question of materials and supplies. So I want to look to some extent at goods in transit. And so on page 684, paragraph 25, right, you speak a little bit, but could you describe the nature and purpose of the goods in transit that the Barbados Light and Power Company proposes to include in its rate base?
Sure. So much like material and supplies, Materials and supplies are the items that we keep in the warehouses, and they are recognized as the items that are in the warehouse at any point in time. Goods in transit represent those items that we have ordered, and most times we would have paid in advance. That's the value of what we would have paid for those items that have not yet arrived. So the distinction between the inventory and the goods in transit is whether they have been received at our warehouse or not. So if we have items that are in the warehouse, those are materials and supplies and typical inventories. The goods in transit are those items that we have paid for that are on their way to Barbados to our warehouse that have not yet arrived.
So in terms of your payment terms,
Yes.
they're always paid for in advance of receipt into Barbados?
Many of them are, and not many of them, unfortunately, are. There are some that we have some credit terms, but generally over the last 5 years or so, there's been a little bit more of a transition to having to pay in advance, and I think that was largely due to delays with getting foreign currency permissions and things of the sort. So some of the payment terms have had to change.
Okay, but most,
my sense right now, most will be advance payments.
okay.
Which is why they're recorded in that goods in transit account.
Okay. So, do your proposed fuel stock, for example, your plant materials and supplies, or your goods in transit accounts reflect any undistributed supply chain expenses like warehousing costs, handling costs, etc.?
No, they don't include. They would include some freight, and they may include some freight, but that would be insignificant relative to the cost of the items.
Okay. So, could you explain to me why you would propose to include these expenses as operating expenses? You're already charging these costs over the fuel stock and material.
Which costs, sorry?
Okay. The costs in relation to your fuel stock, plant and materials and supplies, and goods in transit.
Fuel costs, right, and materials and supplies, right?
You propose to include these in your expenses as operating expenses.
Yes, fuel costs would be in operating expenses. Materials and supplies generally are not in operating expenses. The materials and supplies tend to be largely for use in capital. So I'm not sure the question. So the question is why we've included them as part of rate base?
Well, you have included them as part of your rate base.
Yes, an average amount for fuel costs has been included in working capital for rate base, and an average amount for materials and supplies have been included as well, yes.
Okay. And I now want to take you to page 676 of the application, 676.
Just one moment. 676 of the application. I'm with you.
Right. And I'm looking in particular to number 16.
Yep, paragraph
Okay.
16.
No, the company's making to its rate base, okay, certain adjustments, correct?
Yes.
Do you agree that the increase to the Barbados Lightning Power accumulated depreciation and amortization expense that it will incur in 12 months following the end of the test year is a known and reasonably measured change?
It is, yes.
Okay. Now, are we looking to make any adjustments to this historical test period to reflect a 10% increase to your total gross plant in service and projects that it expect to come online after the end of the test year? Are you looking to make any adjustment to your statement, remember you have this as a historical test period.
Yes.
Are any projects coming online at the end of the test year?
There are projects coming online beyond the test year, yes.
Okay. So what is the basis for reflecting only known and measurable adjustment to net plant in service that caused net plant in service to increase?
As opposed to adjusting what else, sorry?
Okay. So you did in fact indicate that when you look at your gross plant in service, that you recognize that you have some projects that are coming online
Yes.
at the end of the test year.
Yes.
So I'm just asking you, what is the basis for reflecting only known and measurable adjustment to net plant in service that caused the net plant in service to increase?
So the idea for adjusting the net plant, so that there are two elements to the net plant that we would have adjusted for, or that we haven't adjusted for in here. In essence, the request for inclusion of construction work in progress is in recognition of the issue that from time to time you will always have a level of construction of work in progress. Or in our history anyway, we've always had some element of projects that are being constructed and built. And that requires funding, and that requires investment, and the request has been for that to be included, and is consistent with what was included in the last test year. I'm not sure that I follow the question, but why only that? You're asking if we should adjust things for materials and service and so on?
Explain the process.
Oh, sorry, yeah. So the idea is that what we typically do is we take that construction work in progress that we have, we look for those items that we expect to be used and useful within the 12 succeeding months from the end of the test year, and ask that provision be made in rate base to accommodate or reflect that, because that tends to be the natural state of play, having work in progress at the end of the year.
Okay. I have some additional questions on the test year basic revenue, which I invite Commissioner Scott Joseph to lead on that area.
Good afternoon, Mr. Jennings.
Good afternoon.
In the 1992 Electricity Utility Cost Allocation Manual, the National Association of Regulatory Utility Commissioners states that a test year should be representative of the time in which rates are likely to be in effect. Do you agree generally with this assertion?
Yes, that's my understanding.
Okay. After 2020 was determined to be an appropriate base year for developing the test year, you made a number of what are referred to as known and measurable or pro forma adjustments to the actual expenses incurred in that year. Is that correct?
Yes, that is correct.
And these pro forma adjustments are intended to ensure that the test year is representative of the time in which the rates will be in effect. For instance, the addition of operating expenses associated with the Clean Energy Bridge and the removal of rental generation costs. Is this correct?
Yes, that is correct.
Okay. In our discussions with Mr. Blackman, we discussed the level of sales that occurred during 2020. I believe that everyone agreed that sales were abnormal in 2020. Yet, the company has not proposed any adjustments to sales. Is that correct?
That is correct, yes.
Okay, let's have a look at interrogatories 8. Our set dated August 31st.
Question 8.
Yes, please.
Let's see if I can put my hand on it. It says the billing determinants and usage pattern.
Okay. The total sales equal 932.29637 kilowatt hours for the year ending June 30th, 2022. This is compared to 889.943723 million kilowatt hour in 2020.
Sorry, could you call those numbers again? I only have the word, I don't have the actual
You want me
numbers.
to repeat both numbers?
Yes, if you wouldn't mind,
Okay,
please.
that's fine. Total sales equal 932
932.
to 96
Yep.
375 kilowatt hours
And
For-
this is for which year?
for the year ending June 30th, 2022.
Right.
For the period, sorry.
Okay. And the other number you had?
This is compared to 889
Yep.
943
Mm-hmm.
723 kilowatt hour 2020.
Yes.
Would you agree that the level of sales on the system has increased by approximately 5% over the level included in BLPC's test year?
So if you're looking at a year of June 2021 to June 2022, I'm not doing the math, but I could see that there has been an increase if you look at that period relative to the test year. Yes.
Do you agree that it has increased by about 5%?
Well, I could do the math, but I'll take your word for it. It looks,
Yes or no?
well, I would need to, let me see. It appears like it could be. Yeah.
Mr. Jennings, I'm sorry, I would need a response, yes or no?
Give me a minute, let me do the calculation then.
No problem.
Yes, I am coming up with about just over 4.5%, so near 5%, yes.
Please turn to page 758 on the application.
Page 758 on the application. Yes, I'm with you.
Okay. BLPC itself forecast the total sales of 931.1 gigawatt hour in 2022.
That's correct, yes.
Would you agree that it is roughly equivalent to the 932.3 kilowatt hours in sales that have occurred for the year ending, for the period ending June 30, 2022?
Yes, 931 and 932 are very similar, yes.
And for 2023, the year in which rates will be fully effective if approved, what value is shown for projected sales?
944 gigawatt hours. So 944 million kilowatt hours.
Kindly repeat?
944.1 gigawatt hours.
Okay, thank you. What value is shown for 2019 and 2020?
For 2019, 947, and 2020, 889.
And that is an overall decrease of about 6.1%,
That is correct, yes.
although some classes, such as the residential class, saw increases.
Yes.
Presumably, due to stay-at-home over others, do you agree with these numbers?
Yeah, yes, I see them here.
We have discussed with Mr. Blackman that at the time of filing in 2021, there was significant uncertainty over whether sales would be recovered to their pre-COVID levels, despite, I believe, everyone agreeing that the sales in the year were abnormal. Do you agree that sales in 2020 were abnormal?
Sales in 2020, so the point you just pointed out, was 6% lower than 2019, and in 2021, showing some slight increase, and what you have here says about 5% looking like for 2022. Yes.
So yes, they were abnormal.
They were. Well, I don't know how you get to normal. I heard the same testimony that Mr. Blackman gave. It's a very difficult time right now. Right now, we're also facing quite a bit of challenge coming out of the UK and inflation stuff. So, but the point, I'm not disputing the point that in 2019 the sales were 947 gigawatt hours, and the sales to June 2022 were 932 gigawatt hours. That's observable, yes.
Okay, I'll move on. Do you believe that the overall level of sales in 2020 is representative of those that will occur in the period that the rates are in effect?
So, based on our forecast, no, it does not appear that the level of sales would be exactly the same as what would have occurred in 2020. I don't want to jump ahead of your line of questioning, but I think similar has to be said for the level of expenses and the level of depreciation as well. I don't think that looking at sales in isolation is appropriate, and I think that we need to make sure that you look at the sales and you look at the expenses to make sure that what you land with as a revenue requirement leaves enough for a reasonable return to be able to be earned.
So how then is it justified, given the actual recovery in overall sales and the increase in sales shown by BLPC's application?
Sorry, say that again. How then is it justified?
How then is it justified given the actual recovery in overall sales?
Right, so that's...
And the increase in sales shown on BLPC's application?
Right, and that's what I was trying to mention a moment ago. The reason that it is justified, in my view, and I think it's here in the numbers with the forecast that we have, is that while sales do show some recovery and are forecasted to recover and have been recovering along the lines of what we have projected, so too do the expenses increase, so too do the depreciation increase, and there's also an additional level of other things that need to be done relative to the managing the grid and making sure that we are prepared. So all I'm saying is I observe the same phenomena you're observing and you're noting here. I get it. But I think to look at it in isolation would be to do a disservice, which is why the application you have in front of you is what it is, which is for the revenue based on the test year. And I believe that that it's a reasonable ask and it will lead to a reasonable return. I mean, you don't have to look very far to see what's happening in the world right now anyway.
Mr. Jennings, for the record, we are not looking at this in isolation.
Sorry. I was referring to my own assessment of it. I apologize.
Is it the company's current position that no adjustment should be made in the test year level or of revenues?
Pardon me, say that again?
Is it the company's current position that no adjustment should be made to the test year level of revenues?
That is my position, yes. And I believe
is it the company's position?
I was about to say, and I believe that to be the company's position as well, yes.
Thank you, Mr. Jennings.
No problem.
Were the Commission to determine that an adjustment to revenues was necessary, does the company have a position on how an adjustment to sales would be made in order to normalize the test year?
I think the position would be, it would have to be an adjustment that allows the company to earn a reasonable return in the period through which the rates are expected to apply. In my view, that I think such an adjustment would not be appropriate.
Mr. Jennings, does the company have a position on how an adjustment to sales would be made?
I am not aware that any such position exists, to be honest with you.
So, Mr. Jennings, let's refocus.
Yes, Commissioner.
If you look at recoveries, given what you have projected in comparison to the actual sales, if the Commission were to determine that adjustments are needed, would it still be your position that the number should hold? Or the company's position that the number should hold?
Sorry, can you say that again? I'm not sure I'm following. Say it again, please.
Taking your projections into consideration.
Yes.
And taking into consideration the actual sales. If the Commission are to determine that an adjustment is needed, is it the company's position that they are basically assured of how they will go ahead normalizing for the test year?
Are they assured of how they'd go ahead normalizing for the test year?
Yes. Does the company has a position on going forward how they will normalize for the test year?
Oh, yeah. I believe that the review of what the actual return is the appropriate way to manage and monitor that. I believe that what we've asked for gives an opportunity to be able to attract the investment that we need to attract, to be able to do the things that we need to do. And maybe sales skyrocket and maybe expenses decrease significantly. And at that stage, I think it's well within the regulatory compact that we have that gets adjusted. But I think that the application that we have on the basis that I think that scenario is unlikely on the basis of the information that we have in the forecast that we've done, and the fact that this forecast was done back in 2020. We have a significant amount of experience now, actual data that suggests that the sales that are here, yes, they match the forecast, and the expenses show that as well, but show that the level of earnings still is not beyond what is considered a reasonable return.
Can you clarify that the sales matches the forecast?
So I'm saying that the forecasted number for the year 2021, the 894 that is there, is not significantly different. That was a testimony of Managing Director before. It's not statistically different to the actual sales that would have occurred in 2021.
Short, Mr. Jennings, and for the record, can you kindly remind us what are the implications if the rate is too low? What would be the implication on investment? Conversely, if the rate is too high, what would be the implications on the investment?
So if the rate is too low, the ability of the company to be able to continue to deliver its mandate would be impacted. If the rate is too low, we may not be able to make the expenses, we may not be able to manage, it depends on how much too low it becomes. We may not be able to manage the expenses, we may not be able to attract the capital to be able to make the investments that we have identified as necessary to be able to continue to deliver the safe, affordable, reliable service that we want to deliver for customers. And if the rate is too high, the monitoring, I believe, of it will allow for an adjustment of it.
To clarify, what do you mean by to attract capital?
Oh, sorry. I mean to be able to raise the capital, to raise the debt that we need to raise to be able to fund the additional investment, that we have projected.
Debt is not capital.
Debt is not capital. Okay, sorry. I stand corrected, and it's on to raise the debt to be able to fund the level of investment as required.
What's the risk if it's too high?
Sorry, I just said if it's too high, I believe that the tools available through the regulatory compact of being able to adjust it downward can be invoked and resolve that issue. But in my view, I see a significant risk to it being too low, given that its application was filed with a 2020 test year, and we're at the end of 2022 and still in the process of hearing it. Relative to, I think the risk of it being too high is a very low risk, and I think the risk of the rate being too low is a far more probable outcome.
Thank you.
You're welcome.
Mr. Jennings?
Yes, ma'am.
Earlier, when you were testifying with Mr. Huck in relation to depreciation, you described the process of including the cost of labor in capital projects. Can you briefly describe the process for us?
The cost of labor in capital projects?
Yes.
Okay. So typically for you mean the procedure as to how it works, or the elements that are included?
The elements that are included.
Oh, the elements that are included are those elements of labor that are directly attributable to the capital projects that are being developed.
So when looking at your income statement then, only the uncapitalized portion of labor would be included in the expenses being requested by the company, correct?
That's correct, yes, ma'am.
In response to question 61 in the FTC's interrogatories dated August 12th, your exhibit RB31.
Which question, sorry? August 12th? Let me just make sure this is August 12th.
Yeah, question 61, exhibit RB31.
Question 61. Yes, I believe this is the question. Referencing page 697, Schedule C3, please respond to the following. Confirm projects adjusted as year and test year.
Correct. The company stated that $9.66 million in salary expense was capitalized in 2020, with $11.25 million and $5.55 million being capitalized in 2021 and 2022 year-to-date respectively. Is that correct?
Sorry, can you quote those numbers again? 9.66 in 2020.
11.25 in 2021 and
11.25.
5.55 million year-to-date 2022.
Sorry, say the 2022 one again for me.
5.55 million.
5.55. Okay.
That's correct.
You said that was in this response to this interrogatory in 61?
Yes. Exhibit RB31.
I'm not seeing that.
You don't see the exhibit?
No. Well, what I have up is what I have. This is from August 31st for the FTC, right?
No, August 12th.
August 12th. Sorry, my apologies. Let me see. August 12th. Question 61. This relates to a spreadsheet. Let me see if I can locate the spreadsheet as well. Not seeing that. If it is in a response to interrogatory, I believe it to be correct. I don't want to hold you up unnecessarily.
Okay.
I'm looking for it though, but.
So is the lower amount of salary expense capitalized in 2020 due to interruptions caused by the pandemic?
Oh, I wouldn't know that without doing some sort of analysis on it, I'm afraid. I don't know. It would depend on what work was scheduled to be done, what the needs were. I don't know that it would be as simple as delays to do with the pandemic.
Would the amount of capitalization be dependent on either the number of hours worked on capital projects or the amount of capital investment in any given year?
It would be dependent on the number of hours worked and the level of cost associated with those hours. It's largely directly is I'd say the number of hours worked, the level of effort, and by the people who do it, it typically is the direct capital for the people who are involved in the capital projects.
Why does the company believe that no adjustment is necessary to the level of capitalization to reflect the abnormal conditions in the test year?
Sorry, I'm not sure what the impact of the conditions in the test year would have had on the level of capitalization. It's time and expense based on how much time people spend doing the capital work, and it's directly the work that was capitalized represents the cost of the work the amount that was capitalized represents the cost of the work that was done on the basis of the work that was actually done. It's not a situation where there was some other factor at play. So on that basis, there'd be no need for an adjustment. It represents the actual cost of what was capitalized, the actual cost of the capital.
I want to move on to some affiliate transactions.
Yes, ma'am.
In response to the FTC interrogatories dated August 12, 2022, exhibit number RB31, question 32, BLPC stated that it provides space to AmeriCaribbean Inc., BLPC's holding company and shareholder, and that $237,000 related to that office was included in the revenue requirement. Is that office space used only for providing services to BLPC, or are services provided to other affiliates of BLPC and AmeriCaribbean Inc.?
So that office space is used by AmeriCaribbean, and perhaps the way that answer is worded can be misleading. The revenue that has been required from customers is reduced by that amount. So if you look at Schedule D1, you'll see that when you do the calculation and you come from the operating income plus the expenses, you'll see that there's that miscellaneous revenue that that has been deducted from the revenue requirement. Does that help with the question?
Do you pull up the schedule for us?
I can, yes, ma'am. Volume 3, D1. Yeah, so included in this investment income here, I don't know if you can see it. Included in this investment income here of $326,000 is that $237,000. If that were not included there, then the rate ask would be higher. I don't know if that helps. Can you see it? You need me to make it more legible.
Okay, so you said the office space is not included in your rate ask, correct?
That's correct, yes, ma'am.
So that's not an expense which will be recovered from the ratepayers, correct?
That's correct, ma'am.
Can you tell me how the amount of rent charge was determined?
Not off the top of my head. I believe that there was a survey of, well, a survey. I believe that there was an assessment of office space of similar amount and the square footage, and equivalent rent was determined. I don't have it in front of me, but I'm fairly sure that can be provided if it is necessary.
And can you clarify for us whether BLPC receives reimbursement from its affiliates for costs related to goods and services that BLPC incurs on behalf of those affiliates?
Oh yes, ma'am. If BLPC incurs costs on behalf of its affiliates, it recharges them. Yes, ma'am.
Okay, so as BLPC receives reimbursement from its affiliates for costs related to goods and services that it incurs on behalf of the said affiliates, does it reflect that reimbursement as a reduction to the total revenue requirement it seeks in this proceeding? And if so, could you point us to where the reduction is shown?
Yeah, so if we incur costs for goods or service on behalf of an affiliate, it doesn't go to the income statement. It goes due to or due from the related party. So it goes on the balance sheet and does not come into the income statement at all.
Okay, could you refer to the non-consolidated financial statements, please, at page 80 of the application?
I can. I'm with you.
So in 2020, AmeriCaribbean charged $2.2 million in salaries, $340,000 in pension, and $50,000 in director's fees. Are these transactions included in BLPC's revenue requirement?
So that's not what this note is saying. What this note says is, so under, I can't remember the exact standard now, but I believe it's IS 38 maybe.
I'm not asking for clarity on the note. I'm asking you whether the sums as stated in your audited financials are included in the revenue requirement.
What I'm trying to correct is that this does not represent charges from AmeriCaribbean. This is a requirement on the accounting standards to show key management compensation at BLPC. So this is not a charge from AmeriCaribbean. So under the accounting standards, which is what I was trying to point out, under the accounting standard, there's a requirement to show key management compensation in a separate note, and that is shown under the related party transactions note.
Could you also continue to page 81 and describe the transaction that resulted in BLPC being due $993,000 and describe how this transaction has been treated when calculating BLPC's revenue requirement?
So this would be an example. I couldn't tell you the exact what was actually paid for, but this would be an example of BLPC paying for something on behalf of AmeriCaribbean, which would then be repaid, and that would go straight to the balance sheet and not affect the income statement at all.
Now, could you go to page 712 of the application?
I can. That's in volume 3.
Yes, please.
712.
712.
Yes, sir.
And I'm looking at item number 27. Now you have 1,031,925 in your supply chain purchasing. The expenses would be detailed at D7.
Well, I think D2 probably is what you're referring to. This schedule here.
Right. Yes, okay. So I'm just asking that you're showing some in supply chain purchasing and some in supply chain storage expense. So does Barbados Light and Power propose to include its supply chain expenses as a current operating expense rather than a component of its materials and supplies working capital in the rate base?
That is correct. These costs represent the operating expense associated with running those sections. We have a centralized purchasing function and a centralized warehousing function, and this is the operating expense associated with both of them.
I have a couple more questions, but we would invite intervener Ricky Wendt to do his cross-examination at this time. Mr. Wendt?
Thank you, Mr. Chairman. Thank you very much. Good afternoon to all. Thanks for accommodating me this morning. A bit better. Mr. Jennings, you would recall that when Mr. Blackman was on the stand, I raised a number of things with him that were been asked to, wait until you were with us. So I'm hoping that you'll be able to help me with some of them, if not all of them. Because some of them, were fairly straightforward, but we'll go. So, first of all, I just like to know it's fresh with you. I probably should just like to clear it because when the commissioners just asked an important question relating to sales and no adjustment on the revenues on the test year. And it might have been commission, but I think enough information was there to show that there's been upside already from compared to 2020, that sales has improved. Could you explain to me then why there would not be an adjustment in the test year for known and measurable change after we recognize that 2020 was abnormal?
Sure. Like I said.
Excuse me, Chair. That question has been asked, and as Mr. Wendt himself indicated, Dr. Scott Joseph would have gone to that issue. I don't know we need to revisit it.
No, Mr. Chairman. We want to share that all known and measurable changes are reflected. It can't be that sales are lower and then the revenue requirements show the sales lower.
Mr. Wendt,
I'm not understanding. I'm trying to understand if 2020 was lower in terms of all around hotels close everything.
Yeah, Mr.
Why
Wendt,
is it?
Mr. Wendt,
Why is it asking? Sorry, go ahead.
yeah, well, we said we would have asked that question, why the company did not seek to make an adjustment and indicate that they would not be making an adjustment. So,
I don't understand why.
but Mr. Wendt, it is their application. So, if the
Oh, I'll go with that.
okay,
I will go with that. I suppose the commission will have discretion on other things. No problem about that. That doesn't seem intrusive to me. So let's go then to the rate of return. I'm still puzzled with that. Let's go to rate of return. What is the process of achieving that rate of return? You said to me you need a high rate of return to raise debt, and it's attractive. Is the company able to raise debt at 2.78%, Mr. Jennings?
That's correct. Currently, the weighted average cost of debt is 2.78%. That is correct.
Work a simple calculation. If the return on equity is 12.5%, and the value of that equity, that value for, let's say, the investment you need is $100 million. Will that not be that, counter your argument, is that would I not be better off paying less return but a higher debt to raise the same amount of money?
I think that question is probably better put to the cost of capital expert that comes after me. I would have said this morning that a lower cost of debt compared to a higher cost of equity is a relationship that exists, but to a certain point of debt to equity, we've applied on the basis or using a point of 65-35. But to answer your question specifically about whether it would make sense to use more debt than equity, the answer I gave this morning, which I appreciate you may not have heard, was that works to a point, but then beyond that it perhaps does not. But it's a little bit outside of my expertise as such.
Mr. If you remind me of your projected requirements for debt over the next 3 years.
So the forecast, so the next 3 years based on the based on the forecast with proposed rates. Just give me a moment, I'm trying to fill it up. It's, I believe, in L1 of this application, which is page 959. It shows borrowings, projected borrowings in 2021 of 84.9 million, 70 million in 2022, and 30 million in 2023.
And that gives a total of how much?
Roughly 185 million, I believe.
Right. So what I'm struggling with, Mr. Jennings, you have to help me. If I have to raise $185 million, and I have the kind of balance sheet that you have, and I'm raising money at 2.78, what chance would I have to raise that call it $200 million? Has there been any time that, go first and I'll ask the question.
The challenge we would have with raising it, and it's not just a matter of raising it, but raising it at reasonable rates, because you're trying to make sure that you don't end up with a higher cost of debt that then informs or impacts the weighted average cost of capital that we would be requesting. The challenge with raising it is being able to demonstrate that we still have the level of risk and are able to earn a reasonable return.
So
and without a rate adjustment, sorry, you were saying something?
Yeah, no, I'm just saying you finish, because
okay.
I want to get
Yeah, so without a reasonable rate of return, our ability to raise that capital, first at reasonable rates and then potentially raise the debt at all, would be constrained or challenged.
Have you had any experience with line 4 where you had hoped to raise debt in the market at all that you weren't able to raise?
No, sir.
What would be the highest interest rates that you was raised debt at for any time?
Over what period? Currently,
Over the last since the last rate hearing. Because when I remember looking at your balance sheet,
Mr. Wendt, give him an opportunity to answer the question.
Sure,
please.
sure. Over the last 10 years, what would be the interest rate of debt?
So I believe, I may be wrong, without checking, I believe that the highest interest rate that we would have had, I think, is about 5.8, 5.9% on a $20 million facility that we have.
I think you're correct, because the last one was 2.05 on I think it was the 100 million. So what I'm struggling with, if I go back to my finance, and I'm struggling, I want to raise $200 million. And if I say that is at 6%, the highest of all, and you're raising that at 2.7, could you explain to me what difficulty you were going to have to raise that $185 million at 6%?
Right, and the ability to raise that debt at the 2% was on the basis of a projection which included regulatory relief. So I have not, to answer your question specifically, I have not tested what it would be if we don't get that rate relief. My expectation is, given the projections that are included here, without the rate relief, you would have a significant challenge in trying to raise it at I think that providers would see an increased level of risk. I think the debt service coverage ratio would be higher. I think the debt equity would start to drift closer to the range of default, and I think that those things generally
range of default.
So I'm not sure if you heard.
I'm trying to understand what you're telling me.
I was going to clarify. I was saying that we have two. When I gave testimony, I think yesterday, I said that there are two key metrics that we look at: the debt service coverage ratio, and the debt to equity is tangible net worth to total debt. And the place that we default is 1.25 times on the debt service coverage ratio and 50-50 on the tangible net worth to the 50-50 on the debt equity, or the tangible net worth total debt. So if you're trying to raise the additional debt, the 200 million, and you don't have enough earnings, you start to veer close to that, which would put you in default. I hope that helps with the question.
So I support the concept. What I can't understand is that at 2.78%, I could understand a premium being paid above that you wouldn't be able to get it at that kind of rate. Whereas your 6% to raise that. And the reason for that is because some of my colleagues are asking me, they would be Trevor has his constituents with people. Why is it that the borrowers somehow conclude that to get it the equity closer to 65-35, that the 185 or the 200 million can't be raised by debt without having to distribute the retained earnings? Explain that to me.
Sorry, can you?
Even if the interest rate is 6%.
Sorry, can you run that by me again?
Yeah. The struggle is, Light and Paul, in testimony from both yourself and in testimony from both managing director, says part of getting this structure right, or to your interpretation of FTC 65-35, is that you are paying substantial dividends 7 years above the net income. But that is in order, one of the objectives is in order to get to a 65-35. I'm asking, is not what would preclude you from offering, getting debt of 185 million, not at 2.78, stay higher, at 6%, twice the rate you're getting now or more. that we would not have to see the level of dividends to get towards this migration of the expert? What would preclude that from getting this rate?
So that I think would be that I think is better put to the cost of capital expert, because there are a couple of things that may affect that. One is the level of the capital structure, I think, has an impact on the estimated cost of equity, and that, of course, I think would need to be modeled, and then, of course, looking to see what it does to the cost of equity and the cost of existing debt. So if you raise debt at 6%, you got, I think we'd have to figure out what that would look like in terms of the overall weighted average cost of capital, what I would do to the cost of equity, and then, of course, you have to test that to see whether the market is open to it or interested in it as well, I think. And none of that has actually been done.
Now, Mr. Jennings, did you not say to me that you were able to raise debt at 5.9%?
Raise debt at what? Sorry, say it again.
Did you not earlier say to me over the past 10 years you were able to raise debt?
Yes.
On route to bar at 5.9 without difficulty? That
is correct. That was raised.
So I leave this here, but I'm struggling still. What it is that would preclude you from, instead of 185 million, $200 million, because I want to see this perception of debt being, the target being reached by just paying out dividends. That doesn't sound right to me. So could you have to give me some reason what you envisage, and I will take, as you say, I will take it then to your cost of capital expert.
Thank you, sir.
What are the reasons that would preclude you from raising 200, in your opinion, would raising $200 million? And I'm using $200 million because I think the unit told me they have that already, so tell me.
Sir, I do believe the question has been asked and answered. If he is inclined to put it to the expert, he may, but repeating the same.
What is the answer to that?
Offer no.
Mr. Chairman, I haven't got the answer to it. So if you want me to leave it for the expert, I will. But I've noticed in a trend that once I can't get my answer, it goes to the next person. But Mr. Jennings, I'm going to do that on the basis that you will be coming back. So let's go on again.
So let me ensure that that Chair, Mr. Wendt, is aware that Mr. Jennings will only be returning in the context of a witness panel on specific issues as highlighted by the Chair. So I don't wish Mr. Wendt to go away and say that he understood that Mr. Jennings, was coming back. There is a specific purpose for which Mr. Jennings is coming back, and it won't be on the matter that he's now being asked.
Well, then I'm asking the question Mr. Jennings just says to me. The company was able to raise that at 5.9%.
Mr. Wendt,
I'm asking Mr. Jennings to explain to me why we would not be able to raise 200 million at 6%. I haven't got the answer.
Sir, the question asked before was why he wouldn't be able to raise 185. He just add $15 million on it. There ain't gonna be a different answer as to the substance as to why it won't be raised. It's not a different question.
Okay. Mr. Wendt and Councillor just would want to indicate that in the event that a question is posed to the expert in relation to cost of capital, and the person has given information based on a study, but if there's information that, in our opinion, would be better obtained from Mr. Jennings, we would wish to recall Mr. Jennings to be able to answer such a question if it is related to the financials of the company.
Sir, we understand, and that is the discretion of the Commission. I was not speaking to that. I was speaking to the specific query that Mr. Wendt raised just now.
Yes, I understand. So, Mr. Wendt, could you...
Thank you very much for that, Mr. Chairman. Yes, thank you very much. Mr. Jennings?
Yes, sir.
I want to touch on insurance, but from a comprehensive insurance. I did ask Mr. Blackman to provide us with the insurance document I saw last night. One of them. There's a document though that.
You have the question, Mr. Wayne?
Yes, I do. That emerge study, Mr. Jennings, did that look solely at T&D?
I don't have it in front of me now, but I believe that it did look at T&D.
Yeah, I read it fairly quickly. I was reading very fast, so I might have missed something. But based on what I was saying, it's T&D. The value of the T&D is the value of T&D right now in the 2020, $330 million of the net book value.
At the end of 2020?
Yes.
Hold on 1 minute, let me try to get there. I'm just going to schedule C2 and yep, I'm with you. $330 million is the net book value of T&D. Yes, sir.
And while you're there, would be kind enough to let me know what's the value, net book value of the generation?
The generation, 264 million.
Right. No, I would have liked to get before, but if you said and I didn't get to see it. This was, what is the coverage then on the generation?
So I believe that is being prepared, and you should have that soon.
I'm going to have to come back to this.
Yeah, but I mean, yeah.
No, I'm going to have to, because what I'm trying to find out is that the act was presented. Oh, your question to you. Does the act allow the fund to cover generation short?
I believe the act allows for generation.
So that's why you see I need the annual cover for the insurance, general insurance.
I understand. That, as I understand, is being prepared to be sent to you.
Now, are you aware that the initial injection of the fund was $4 million?
The information I've seen suggests that the first payment into the fund was $2.5 million.
Let me just bring my numbers just a bit, please.
Sure.
My numbers are not going to be wrong. Let me bring my numbers up very quick. One minute, Mr. Chairman. My numbers are going to be here. Spend hours to get these numbers right. Yes. In 1998, if you're speaking prior to that, the total in the fund would have been $5.581 million, with $1.581 million as other insurance, which would be presumably general, and the insurance fund was $4 million. And you can look at that at page 17 in the notes of the 1998 accounts. So the question for me, though, you can always check it, but here's the question for me. I want to get an understanding, what is the value of the coverage for the insurance, the generation? Because what is the value of that? But once you get that, the next you have to do, if it was possible to include the generation under the sale. That's what I want to get. And then that's what I want to get. Right. So could I ask it now, or you want me to come back?
Well, I'm not sure I followed the question. So do you want to know the value? Hold on. I could explain what I understand. You could tell me where so the value for coverage of the items, and then you want to know what the value of the generation net book value is? That's what you're trying to get?
Generation net book value already. You give me that as $2 million. What I want to get is to cover that. What would be the insurance?
What amount of cover we have for generation?
Yeah, that we're paying no third party. See if I can take that.
The cost of the insurance.
Yes.
Oh, I see. Yeah. So as I understand it, that is what's being prepared to send to.
Do you know if any consideration was given at all to including the generation into the fund that we can reduce the insurance coverage on the general?
I don't know whether that probably predated me. I don't know if there was.
No, I mean right now, right now. Because
right now, to the best of my knowledge, no. To the best of my knowledge, the focus has been to get commercial insurance where commercial insurance is available, and for good reason. The commercial insurance is far more attractive generally than a self-insurance.
You're aware though that the self-insurance fund, are you aware the self-insurance fund was meant to be adequately covered back in 2011? Are you aware of that?
When you say it was intended to be adequately covered,
when the CGM would have said it was 128.4 million?
Right, yeah, I understand that in 2011 a study was done as well then, yes.
Right. No, what I'm trying to get to understand, if it is that the generation and that money is there, and it's too much for T&D, what I'm trying to get to understand is if there was funding that we could have covered some of the generation under it, okay. And even if there was more to cover, then cover it on the general.
I understand what you're asking.
Yeah.
No, I don't know if that was considered or what the impact of that would have been. No.
Right. Apart from passing the additional $4 million in the non-measurable for insurance, apart from doing that, what other considerations were done, or what else was considered to see how we could reduce that insurance?
So as I understand it, a number of the asset management team tends to get involved in an annual loss management visits, and they work very closely with the insurance brokers to see what types of activities can be done to try and maintain and control the cost of insurance. I'm fairly sure they'd be happy to walk you through what types of initiatives they've done. There's a little more than I am intimately aware of. I do know that they do quite a bit of work with the insurance brokers and trying to control those costs.
So, Mr. Jennings, would I be correct to conclude that you're not aware if any attempt was made to include a generation into the self-insurance fund? And would I also be correct to conclude that those funds were returned to the shareholders to get towards the debt equity ratio?
You'd be right.
And would I also be correct then to understand that?
Mr. Wayne, allow Mr. Jennings to respond.
Oh, sorry. I was giving them all three one time.
Sorry, Mr. Wayne. The reason I interrupted is because the first one I agree with. The second one, I don't think we kind of discussed that this morning as well. I don't think that the return of the money to the shareholders was necessarily done as a result of making sure that that equity structure was maintained. But we did discuss that if it was not returned, you would have ended up with a deeper or a higher level of equity in the capital structure. So I was just clarifying that. So what was the third one?
I'm getting it. You're saying if you had taken, I think I'm agreeing with you. You're saying if you had taken out of the self-insurance fund,
yeah,
and then put it back into the company, but then paid out of dividend, what you're saying, you would have increased the average equity.
That's
correct. Would I be correct?
Yes, sir.
So you paid out, but it would make it worse from your perspective. All right, let me ask a question on this. How could I go to ratepayers? Yeah? To say to them, I was part of the interveners team that saw funds invested being able to cover generation, and I did nothing about it, but then find myself saying to them, I want an increase of 50% in the non-measurable change for insurance on the general insurance. Tell me what should I say?
Mr. Chairman, I believe the question as posed requires the witness to speculate and is a bit unfair in the context. Perhaps it could be reworded.
Yes, Mr. Vent, would you be able to rephrase the question?
Okay, let me ask this another way. Mr. Jennings?
Yes, sir.
What is the known and measurable amount before that? What is the insurance cost for in 2020? What was that insurance cost?
In the test, I believe, is about 8.2 million.
This is before the known and measurable change, correct?
Yes, sir.
Right. Prior to 2020, that 8.2. What was, give me 2019 and give me 2018. That's just give it.
Give me a moment, I'll see if I could locate it.
Sure. All right,
So in 2018, insurance was 5.1 million. In 2019, 5.8 million, and in 2020, it was the 8.2 million.
8.2 million. Yeah. So we're averaging 12.5, and then we're past 25%, even before the known and measurable change. So the known and measurable change was how much again?
4.1 million, sir.
Which brings us to 12.1 million, correct?
12.3.
And would that be part of the revenue requirement for the 46 point X million?
Yes, sir.
In your opinion, Mr. Jennings, as Director of Finance, is that reasonable?
I think it is, sir. The reason I think it is because, as I said earlier, the third-party insurance, general third-party insurance, I think is far more desirable than trying to use the self-insurance fund reserve for assets. We only use the self-insurance fund for assets that cannot be insured or cannot be insured at reasonable rates. And while I'm no expert on it, I don't know what level of reduction in self-insurance some portion of the generation assets would have had on that insurance premium. If you look at what's been happening globally for the third-party insurance, the cost of the insurance has been increasing, and we believe that it is more desirable to use that third-party insurance. It brings better benefit.
Yes, Mr. Jennings, on that study that was done by CARB, I think it's CARB or maybe CGM Gallagher, one of their group members. Was part of that study concluded that the fund just required the 10% to cover installed poles? This is part of your study. I think that was in a response to one of my interrogatories. That would be on 4. That would be. Let me help you with that.
I think the content of the study and the rationale behind it probably is, well, let me see if you go ahead with the question.
Question 8, that was an interrogatory response to my question about the why the 146.1 million dropped to 50.2 in 2016. And I think part of it, if I can read, the adequacy of the self-insurance fund is evaluated periodically, and assessment was conducted in 2016 that recent insurance by Gallagher and historic hurricane experience and tropical storms, and they computed that for transmission and distribution that for poles, they concluded that the range of expected damage is to the 10% of installed poles.
Mr. Vent, you've posed the question?
Yeah, the question is, apart from the CGM projection of the amount required from the experience to cover fallen poles. What else could you tell us about the amount that would be necessary in the case of a disaster, that we can get a good feeling that the amount that is left would be reasonable to cover the plan?
So I think that the questions on the content of the study probably a better place to the asset management folks.
Asset management group. Okay,
Yes, sir.
Okay, I can leave that alone then. So, Mr. Chairman, that part of it is quite good for me, Mr. Jennings, at this point in time. Not happy yet, but I'm getting there. You've taken it a little bit close.
You have a lot more questions, or you're wrapping up now?
Oh, certainly, sir.
And all of these questions are for Mr. Jennings, or some of them could be
Oh, yes,
the
because
other?
I want the managing director to answer these questions.
I'm just asking in relation to your questions. We want to make sure that, and if the question has been asked earlier and you had an answer, we could move on to another area. So just want us to be mindful that we don't need to go over the same information, but only focus on any area that you have not heard addressed so far in the hearing.
Yeah, you're so correct, because had I got the
yes, okay,
coverage
so
of the general insurance, they would have been closed. So next one is the tax refund. So Jennings?
Yes, sir.
Is Tampa Electricity one of the, either part of the Ameri Group or one of them, affiliates of it, a member of the Ameri Group?
To the best of my knowledge, yes, sir.
Are you, would you have seen the annual report of the Ameri's annual report of 2020?
No, sir.
You would not have seen it.
No, sir, I have not seen it.
Okay. So therefore, you would not be aware that, similar to Barbados, in 2018, if you go to page 108, when you get a chance.
Okay. We indicated that he did have not seen it, so.
Yeah. So, but I want, so that this is pertinent. The Florida Public Service Commission.
Yeah, Mr. Wendt, if it is not relevant before.
Okay.
So,
No, it has to be. Has to be. You send me the document, Mr. Chairman. The FTC sent me the 2020 Ameri statements. And at page 108, it says that the federal government give a tax rebate to Tampa, and what the Florida Public Service Commission did was to, so are you aware that Tampa Electricity enjoyed a windfall just like Barbados due to the 2018 U.S. tax reform benefits? Are you aware of that?
No, sir, I was not, but I don't know that I would characterize that it certainly, the tax situation here certainly didn't lead to any sort of over-earning or significant over-earning in any way in 2018. Were it not for that, the rate of return in 2018 would have been, to my sense, just around 8%, which I just saying in terms of your commentary about it being a windfall, I think I would characterize it slightly differently.
No. What I don't understand is that Tampa Florida Service Commission, my question is Tampa Florida Public Service Commission was able to say to Tampa Electricity that commission says they adjusted the rate base by $103 US.
I let the first
Why
question
could it not happen
go.
here?
Mr. Wendt, give me a moment, please. I let the first question go. I let my witness answer. I didn't think it was relevant.
Oh,
now
sorry.
he's asking Mr. Jennings to speak to the question as compared to Tampa, why they did what they did, why the utility over there did that, and make a comparative. That's an inappropriate line of questioning.
Mr.
In the context where Mr. Jennings says he's unaware of the issues with Tampa.
Mr. Chairman, that is information that came to me that the commission sent to me. but I got a copy of the document. I read as much as I can to get about Barbados. That's why I had to ask for consolidated. And the print was fine, and I normally have my magnifying glass. So I'm asking, the Foreign Public Service Commission was able to reduce the rate base annually to reflect that change. And the exact same thing happening in Barbados. I'm trying to understand why would the FTC not be in a position, if they so choose to desire, to make adjustment on the rate base?
Okay, there's a question for FTC and not for the witness.
I need to hear that. But Mr. Chairman, it can't be that you send me documents, which I take my time to read, related to the hearing.
Yeah, Mr. Wendt, we note your information, we hear your point, and we're asking you to move on.
Appreciate that. I'm not going to be long on this one, but I got to get closure. Mrs. Jennings, is it correct that in earlier testing you said that there was $19 million spent on the steam plant?
Between 2018 and 2020, I believe it was 19.2 million is what was in the interrogatory response. Yes, sir.
And is it correct that that translates over that period on the remaining life to be about 4.5 million? The amount?
The depreciation charge, including the test here, is 4.5 million. Yes, sir.
Right. So, Mr. Jennings, do you agree that the FTC has the discretion to allow the imprudent investment, to disallow imprudent investment?
Do I agree that the FTC has discretion to disallow imprudent investment? Sorry, is that the question?
Yeah. Yes.
I don't see any reason why not, but I don't know that I would. Sorry.
Okay. So, would you recall that from testimony previously, the steam plant was to retire in 2012? That repairs can benefit 30 million a year. Would you recall that?
Mr. Wendt, just a minute, please. I think we went through all of this line of questioning when we were dealing with the depreciation issue. We're on to another area, and we're asking that you speak to the other memorandum that Mr. Jennings would have signed, because we've been through the memorandum relating to depreciation. So could you move on?
Yeah, could you let me close this, please? What I'm trying to understand.
Is this related to depreciation, Mr. Wendt?
No, what it relates to, Mr. Chairman, is the revenue requirement, which is where my whole focus is on today.
Yes, and there are a number of things included. Just give me a minute. There are a number of things that have been included in the revenue requirement. Depreciation is one. I believe we have exhausted the depreciation discussion, and I'm asking you to move on to some of the other areas. So you've touched on a number of the other areas. So could you move on from depreciation to some other area of the revenue requirement that we have not already discussed?
Could I be allowed to close this, Mr. Chair?
Please do.
I've asked Mr. Jennings if he knows that the regulator has that discretion, because that 4.5 million depreciation expense, I'm asking him if he's aware that the commission has the discretion whether they allow that or not, and then I can move on. That's just, I want that to be clear.
Yes, I'm aware they have that discretion, sir.
Okay, thank you very much. Mr. Jennings? No, what I'm finding is that I've got questions that I had from Mr. Blackman that was supposed to be yours, and I expect to get that.
And we did indicate that if there are situations where we need to recall Mr. Blackman, so focus on Mr. Jennings.
Okay, so Mr. Jennings, as finance director, could you indicate the amount that was spent on the 12 megawatt renting those in 2022?
Mr. Wendt, we went through this. We went through
No,
this
no, I
already.
haven't got, I haven't
Mr.
got
Wendt,
information.
Mr. Wendt, we've been through this discussion already.
Did you get, Mr. Chairman, what it costs the company for the 18 megawatt, to purchase the 18 megawatt generators? Did you get that cost? When there was the outage in 2019?
Yes.
But I want to put that to Mr. Would I be able to get that cost? What I'm trying to understand is then what would it cost a 12 megawatt generator? And therefore, I'm trying to get the figures because in my mind, I'm trying to understand as finance director, if Mr. Jennings could tell me what is the total cost to rent those generators versus what it would have been to buy the 18 megawatt. I have not got that information. I've been searching for it, I haven't got it. The only thing that I know from the non-consolidated financial statements that was sent to me is that $16.9 million was spent renting the 12 megawatts. It's the only thing I know. If you have the information, share it with me.
Mr. Wendt, we would have shared that information with you, and it was sent in an interrogatory. We are asking you to move on. We need to get to other matters, and we are not going over the same issue 4 and 5 times. We have spoken to that issue already, and we're asking you to move on.
All right, Mr. Chairman. Mr. Jennings?
Yes, sir.
On the matter of taxes on income, which is $1.2 million, did the company receive a response from the Ministry of Education relating to my request?
Not from the Ministry of Education and not from
the Ministry of Finance,
to the best of my knowledge either. I was just tugging your leg, sorry. No, we haven't received a response from the Ministry of Finance.
Mr. Wendt, you asked Mr. Blackman that question. So it doesn't, the question was asked and it was answered. Is there a new question? Is there a question for the witness that was not asked to Mr. Blackman?
The reason I asked that, Mr. Chairman, is...
Need a reason. We just would need you to ask Mr. Jennings a question that you did not ask Mr. Blackman. The purpose is not for you to ask every witness the same list of questions.
No, that's not what I'm here for. You were there when I was cross-examining Mr. Blackman, and he deferred certain questions to Mr. Jennings. And
this was not one. He did indicate that no response was, he told you no response was given. Could we move on? He did not receive a response from the ministry.
Did I not?
Mr. Wendt, please.
Yeah, okay.
Mr. Wendt, please.
Let me go with you. I wouldn't get any adjustment at 1.2. I'll go with you. In relation to the restructuring that was done in 2015, Mr. Jennings.
Yes, sir.
What were the total costs for that restructuring?
So, in an interrogatory response to you, Mr. Wendt, on The 31st of August, question 13, we said that the cost of reorganization was approximately 15 million and was incurred between 2014 and 2015.
Correct. What was the benefit that the payback that the company realized from spending the $15 million?
Mr. Wendt, again, this was a question that was posed to the
Mr.
managing
director.
Mr. Wendt, please. It was a question you posed to Mr. Blackman, and he went through his perception of the benefits and those types of things. Mr. Wendt, please consult your notes. I'm just asking you, look through your notes and see if you made any notes in response to the responses of the questions you would have asked Mr. Blackman. And if Mr. Blackman had indicated in your notes that he could not answer and it is better for Mr. Jennings to answer, that is a question that you would ask. But it is the purpose of this exercise is not for you to ask every witness the same question, because you did ask Mr. Blackman all of the benefits related to the restructuring exercise. And this was also in your own interrogatory.
I want to get from the financial controller, what was the payback? Mr. Blackman, you are correct, pointed out they did staff restructuring, he pointed out they did realignment, but I want to get from Mr. Jennings, what was the payback on that investment, which Mr. Blackman could not give me? I asked the question about what was the payback on the $15 million. And the reason for that is that like employees will be restructured again.
So you're asking if the company calculates a return on their training investment or restructuring investment. That's the question that you're asking if the company.
Yes, which is what we.
No, I'm just saying that's the question you're asking. Does the company calculate a payback period on its restructuring costs? Is that the question you're asking?
That's part of the question, and the other is what was it? What was it the benefit of that financially?
No, but okay. Does your Mr. Jennings, does the company calculate a payback on restructuring exercise?
No, Chair.
Okay, the answer is no. So let's move on.
So explain to me then, Mr. Jennings, after the company restructured, and I'm going to work with you, but I'm going to get what I need. After the company restructured, the cost of the company will drop. I think you were, let me just go up my notes here again, one second. Right. So, the cost of the company would have gone in 2015 down to $348 million. And now in 2021, we are at $438 million. And understand, if we deduct the fuel charge, the cost has risen dramatically. Could you explain what would have led to that increase in cost?
So in the same interrogatory response that we had supplied to Mr. Wendt, we show that the operating expenses from 2016 went from 81 million to 94 million in 2020 and 98 in 2021 when you exclude the impact of the insurance costs and the fuel and depreciation. And we say also that in 2020 that jump is largely on account of the cost of rental generation, and in 2021 there's cost of rental generation as well, plus the costs associated with some of the staff for the Clean Energy Bridge.
Right. What adjustments then would be necessary in the question cost? Because what I'm getting from you is that there were one-off charges, and I'm not saying any adjustment on the operating expenses. I mentioned yesterday, or 2 days ago, the credit that you got, which I agree with, And I think the adjustment that you mentioned for penalties, I think it might have been small. What adjustments are required in the operating expense?
So in my earlier testimony this morning, I went through with cross-examination of Mr. Worm. If you look to Schedule D7, it shows all of the adjustments that have been made for known and measurable for the test here. So you have the removal of the cost of rental generation. You have
I'm familiar with those.
Right.
Familiar with those. You don't have to go back to those.
Mr. Van, therefore, therefore, what's the question?
The question is, that's on the maintenance side, because I still am not clear yet. Why would the generation expense on the CV be $4.7 million, which wiped out all of the adjustments that would have been realized from returning the generators?
So
what would you... Yeah, go ahead.
Sorry, no, I'm waiting for what was the question. Sorry.
So therefore, what is then, because I am getting a clean energy bridge going in service, which is giving me $4.7 million if I'm understanding correctly. The steam plant is coming out next year. What is the maintenance on the steam plant that I've not seen in that same schedule?
So I don't have the actual costs associated with the steam plant in front of me, but what I do know is that when you look to Schedule L, you can see the expense profile with the impact of the steam cost being out, and it still doesn't result in over-earning.
No, I'm not clear, Mr. Jennings, sorry. I'm asking that I've got an increase. Sorry, go ahead. I've got an increase of $4.7 million coming from the Clean Energy Bridge.
That is correct. Yes.
So, right? But I'm not seeing any adjustments on maintenance for the steam plant that you say is retired next year.
That's correct, yes.
I'm asking, what is the maintenance on the steam plant now, and whether or not that there should be an adjustment reflected in the known and measurable change?
And I guess what I just said was I don't have the maintenance of the steam plant information in front of me. It may have been submitted as an interrogatory. I'm not sure. But what I do know is that in the forecast includes the appropriate removal of the cost, and the forecast still demonstrates that it's not the revenue requirements with the requested rate does not result in over-earning, and that's the reason why no adjustment has been made.
No.
And for the...
I expect to work with you that if the Clean Energy Bridge is coming in, I expect money from that, additional costs. But if it's equally within the analysis,
Mr. Vane,
what is the cost?
Mr. Vane,
yes, please.
We're asking if you can move along and just ask how many more questions you have that are for this witness.
Can I get answers? I'm going to have to leave my questions for other witnesses, because what I'm not getting...
I'm just asking, you agree to leave the questions for the other witnesses?
But on the basis that if they cannot answer that, Mr. Jennings or Mr.
Mr.
will be coming back.
Right. Okay. All right. Mm-hmm. So, thank you, Mr. Wendt.
Thank you very much.
Okay. And Mr. Jennings, just last two questions and I would like you to go to page 948 of the application.
948.
Show the statement of income. Just like a little bit of clarification.
Yes, sir.
You have it? Okay, right. So we just want for you to, based on some of the questions that were being asked, if you could explain the factors that would be driving insurance, that would increase the insurance here from 11, you see, from the 11.3 up to 22 million by in just, about 5 years' time, that the insurance figure would double, what are the factors you would say are driving that increase?
Yeah, so our recent trend has been suggesting that at the time of preparing this, we were looking at, was it 5 million in, well, I had the numbers up a minute ago. So you can see the trend, where is it, insurance. So we moved from 5 million in 2019, 8.2 million in 2020. Then we round about 11 to 12 in 2021, and we're seeing increase. I was asked a question this morning about what 2022 looks like. I don't have that in front of me, but we are seeing a trend of quite regular and steep increases to the order of like 20-30% on commercial insurance.
But your testimony said that it was more beneficial for the company to use general.
It is, because
than self-insurance.
In my view, it is, because they.
Just go back to the slide there. I'm just trying to get an understanding. The previous one.
Oh.
No, the other one. So it is more attractive to use an insurance that would see almost 100% increase in insurance in a 5-year period.
Where you are still looking at an insurance premium of 20 million relative to the cover that you would get, which is, even if you took all of this and included it every year into a self-insurance fund, you wouldn't have the same level of cover every year. So in my view, my personal view, the commercial insurance is more beneficial than self-insurance.
Okay. And when I look at the general expense category, moving from the 36 to 45, what would be the factors that would be driving that increase? Just so same area.
Yeah.
We're just looking to get an understanding of your operating expenses, huh?
Yeah.
And I just want for you to articulate what you would consider to be the factors that would be driving these expenses, moving, let's say, from 36 million to 45 million in a 5-year period. I'm just looking at these.
Yeah. So the assumptions that we would use to build the forecast would have included inflationary increases in here. So you'll find, typically speaking, that your staff costs increase generally is around about 2 to 3% a year, and you'll find that generally other costs tend to increase like between 2 and 3% per year, and those assumptions are listed in L3 to this application.
And your taxes and other income?
So the taxes,
that would be
other than income.
That would be as a result of growth in your overall net income.
No, the taxes other than income is the land tax. So you would see that the increase that was put here was as a result of the Clean Energy Bridge coming into service, which is the 1.2, and that's pretty much. So the idea here is that it will be held constant over the period.
Okay. And Schedule L.
Yep.
Paragraph 25.
Paragraph 25, yep.
Hmm?
Sorry, I thought you said Schedule L, paragraph 25.
Yes, please. And this is on the right. So, of the memorandum of the 5-year financial forecast, Schedule L, is stated that with the proposed rates, that it is likely that the company will require additional rate relief within a 5-year period to maintain a reasonable rate of return. Now, if the proposed clean energy transition rider were to be implemented, please explain whether the company expects that a new rate request would still be needed during the 5-year period.
So like everything else, I think that would depend on how the rider is defined and implemented and what it covers and how it is administered. I think if the rider provides the opportunity for, if the rider is defined and provides the opportunity for a reasonable return, then perhaps the need for additional relief may not be necessary because the rider may provide it. But again, that assessment would have to be based on how the rider is defined, how it is administered, and what it looks like. As it stands now, to my mind, it hasn't been, fully fleshed out.
Okay. All right. Thank you, Mr. Jennings. And any other questions from the panel? Okay, Mr. Jennings, we thank you for your evidence here at this hearing, and we will adjourn at this time, and on Monday morning we will have your okay. Yeah, public counsel. Okay, I think. Yeah.
Chairman?
Yes.
Would it be possible to know what the schedule is looking like at this time anyway for next week in terms of appearances? Could you remind us of what they are likely to be based on the information we have today?
Mr. Allen?
Yes, sir.
Your cost of capital expert would be available on Monday?
She has indicated she will make herself available Monday to Wednesday? Thursday. So she is available next week. To that extent, we do not require any amendment to the original concept. I am assuming Monday will begin with the re-examination of Mr. Jennings, and then the panel of Mr. Graves and Mr. Jennings and the
well, we were looking at, since the whole question of cost of capital was okay, that
We concur with what Mr. Allen is suggesting.
okay.
That we continue, we finish with Mr. Jennings' financial, the evidence on the financial issues, but there are many things that were deferred to the panel that he would sit with Mr. Seal and Mr. Graves, I believe, and we think it is appropriate to continue and complete that evidence before we go to another subject matter area.
Chair, I am, what I was indicating is that I am flexible now that my witness has indicated her availability. I know I had indicated a preference, I believe it was yesterday or when I was asking you whether. All I'm saying is she is now available, and I leave it to you to indicate your position.
Mr. Chairman, if I could suggest, because there were the deferrals in relation to evidence that might be better addressed by the asset management team, and to avoid a lapse in recollection of what may have been addressed appropriately before, I think it would be sensible to continue with the team, including Mr. Jennings, and then close that evidence before we proceed to the cost of capital witness.
Yeah, we note, but in advice, well, we will, after this, that we would move to the cost of capital, and then come back to the witness panel. So we'll have.
As your chair, please.
Okay. So the time being 3:58 p.m., we stand adjourned on